Morning, everyone. My name's John Hewson. I'm Chair of the Tax and Transfer Policy Institute at ANU. Welcome to our National Tax Summit. Let me begin by paying our respects, collective respects, to the traditional owners of the lands on which we're meeting variously, and to their elders past, present and emerging. I think it's a very opportune time to be holding this summit as the focus in our political debate and globally is now moving to the idea of a recovery strategy from the COVID-19 pandemic. There's an enormous frustration, I think, in Australia that over nearly 45 years since the Asprey Review, we haven't made very much progress in broad-based tax reform. We go all the way through the very comprehensive Henry Tax Review, and still that was just cherry-picked by the political process. So there is an opportunity now in this recovery phase to focus on the significance of this issue. Unfortunately, over all those years, broad-based tax reform has basically been put in the too hard basket by whoever's been in power in this country. Yet we pretty well know what's wrong with the system. We know at personal tax there's too much of a reliance on bracket creep, and we have high tax rates cutting in at relatively low income levels, which is a fairly significant disincentive effect. In terms of corporate tax, there's a question about its sustainability when based on profit, with many multinationals almost paying no tax. The GST system has failed as a growth tax, the basis on which it was introduced, and we have regular fights between the states as to its distribution. We have split taxing powers in Australia between the federal level, the national level and states. The states have two conceptually pretty effective tax races in payroll tax and land tax, but they've been variously neutered and treated by the states in order to attract business. We have a number of nuisance taxes, transaction taxes like stamp and insurance duties, poor coverage of the resource rent tax, and we don't have congestion taxes or an effective road taxing or road charger system. We don't have a carbon price. We have very large and inequitable tax expenditures which are biased in terms of the wealthy, the top end of town. Overall, the system is complex, it's inefficient, it's inequitable, and with some very significant competing vested interests. It's also complicated by the fact that we operate within a federation where there's an imprecise distribution of recognition of responsibilities. There's a significant overlap and duplication in some cases, which means that we actually have a heavier reliance on tax than we might otherwise have in order to fund government. And of course, there's a blame game. We always see examples of where one level of parliament, one level of government blames the others, as we're seeing right now played out in Victoria over the response to the aged care system. Also complicated links with our transfer system. Over and above those well-known, I think, weaknesses of the present system or difficulties of the present system, we've had a couple of other complications coming from the government's response so far to COVID. Firstly, although they say that measures introduced for stimulus reasons or cushioning reasons are temporary, there's no doubt that there will be a significant impact on the longer-term structural deficit. And there are important intergenerational transfers taking place as a result of what's being done. The young are heavily impacted, for example, by the recession, particularly young people, casual workers, lower income earners, with the health and expenditure system being biased towards the aged. So the summit, I think, offers a unique opportunity to address these issues, to try and get widespread agreement as to the nature and urgency of the problem and point to possible reform pathways, cognizant, of course, of the need to recognise the circumstances of separate sectors. COVID's demonstrated to me just how fast and decisively most of us can respond to an unexpected problem, an unexpected challenge. It's been accepted as urgent. We've seen massive changes in our behaviour as a result, both individually, institutionally, governments and so on. We've been able to meet our individual responsibilities and make adjustments to our behaviour within an agreed national collaborative process. So the tax and some federation reform should be an imperative of any recovery strategy in this country. Perhaps as a final comment, we may need to develop a new narrative. We can't sort of run the same old type arguments. We need to find a new way of crystallising widespread community and widespread community support for the change. So I wish you well with the deliberations today. It's now my pleasure to hand over to Viva Hamer to introduce Thomas for the keynote speech. Thank you.
Thank you so much, John. Very good points, and certainly issues and challenges that Tom Barthold is exceedingly well qualified to address as he presided over the 2017 tax reform in the United States, which is amongst the biggest tax reforms ever in the world. So Tom has been at the Joint Committee on Taxation for over 30 years, and he has been the Chief of Staff for over 10 years. In that role, he has become among the most esteemed and powerful tax professionals in the world. For almost 100 years, the staff of the Joint Committee, which serves only Congress and not the administration, assists its members to develop and analyze legislation, preparing revenue estimates of all tax legislation considered, drafting legislative histories, and researching aspects of the federal tax system. Tom is scrupulously nonpartisan. His stamina is legendary. In the rocket speed 2017 tax reform, we, his staff, watched him sit in front of the hot cameras and members of Congress round the clock for weeks without pause. Tom has practiced in every area of the tax law, including capital gains, savings incentives, environmental and energy, estate tax, low-income housing credit, and tax-exempt organizations. Baseball is Tom's favorite sport, and being from St. Louis, he is a Cardinals fan. Even though he has lived in the Washington area for more than 30 years, he was very sad when the Washington Nationals swept the Cards last year in the national championship. Tom played high school football and was on the Harvard graduate basketball and fast pitch softball teams. His children swam competitively from age 5 and have continued into master swimming. His younger child set a St. Louis record in the 100-meter backstroke. So Tom became a certified swimming and diving judge. He tells me judging diving is really difficult. Unlike on the television, there's no slow-mo. That makes it a little like tax reform. There are no rewinds. When Tom started his career, he had reddish blonde hair. One of the big shot lawmakers said, "I am willing to take criticism on the proposal, but not from that young blonde kid." As a result, Tom turned white-haired, and they all take any criticism he has to offer. Tom and I had a back and forth about whether he should be advertised as Dr. Barthold for the program. He told me that while he is proud of his Harvard doctorate, he did not want people thinking he could readily, expertly perform CPR. He didn't want people to think he is good just because of his title. What he will tell us will let us conclude about the same or not. And that Mr. was plenty fine for his father and therefore plenty fine for him. Tom, welcome to Australia. We're looking forward to hearing your wisdom. Thank you.
Well, thank you, Viva. That was an extremely kind introduction, and it's a pleasure to join everybody today. I just wish that I could actually come to the continent of Australia and be with you, but not a very good time for travel. I'm not expert in the Australian tax system and Australian budget problems. So I'm hoping that what I'm able to say today are more, I'm hoping they are lessons that are generally applicable across a lot of legislatures in a lot of different countries. John Hewson just briefly ran through a number of difficulties that your country faces, some of which sound very, very familiar to those of the United States. And a couple of points that were made in some of the background materials were to the uniqueness of Australia, and definitely unique. But let me just point out a few similarities or maybe some of the uniqueness of the United States so you can understand a little bit of my experience before I offer some of my lessons. And let me also preface that you'll probably conclude these lessons are not very deep, but it's really thinking about the political economy of tax reform and how is that achieved and what are important things to think about along the way. So let's turn, Emma from PwC is going to flip the slides for me so that I don't have to operate three hands here. So Emma, why don't you take us to slide number 3, which is a simple graph of federal receipts in the United States by share of total receipts. And I offer up a couple moments of background on the United States. The U.S. federal government is actually more reliant on direct taxes on individuals and households than I believe is the case in Australia. Income and payroll taxes account for more than 80% of government revenue, and unlike Australia, there is no national goods and services tax. The corporate tax has been declining, but is still a broad tax on corporations. Its take, though, has become rather small in comparison to the overall federal budget. Maybe Emma, you can jump us ahead to slide 5. And what I'd like to highlight on in this slide is the highlighted column in the middle. Overall, in the United States, the tax system, counting the excise taxes, counting the individual income tax, our payroll tax, our corporate tax, is generally progressive, but the dominant component producing that progressivity is the individual income tax. The corporate income tax, because of the ownership of corporate equity, is held primarily in the upper half of the income distribution, contributes to that progressivity, but the progressivity demonstrated in the average tax rates on slide 5, the middle highlighted column, are really driven by the individual income tax. And so let me just make 2 notes about the U.S. federal individual income tax. And Emma, maybe in this regard, just jump us ahead to slide 7. The individual income tax in the United States operates as a negative income tax. As you'll see on slide 7, the far right column, on average, the income tax liability is negative for 1/3 of tax filing units in the United States. This is achieved by 2 or 3, primarily 2, refundable tax credits that are based on a family size and the earned income of the family. Many low-income households have no income tax liability and, in fact, receive a refundable credit that exceeds the household's payroll tax liability. Let's so that I don't bore you with the U.S. tax system, since you're worried about reform in Australia, let's just jump ahead to slide 9. This highlights really just the last point that I made. While our payroll tax in the United States is significant, the income tax and its progressivity and its negative income tax features swamp it in terms of the overall progressivity of the U.S. federal system. But you will see in the highlighted column on slide 9 that some 2/3 of taxpayers in the United States pay more in payroll taxes than in income taxes. Well, I have a little bit more information here. That's probably enough said about the United States. Let's skip ahead to slide 12. And I see on my screen, I hope this isn't for everyone, that there's a little bit of a breakup. So I hope we're all together in this virtual world. But tax reform, budget reform, that's really the question of this conference. John Hewson mentioned that it's been 45 years stalled, in his view, in Australia. Over the past 35 years, largely my experience in public life, there's been major tax legislation, major reform legislation in the United States, and I want to highlight 4 particular pieces of legislation. First, landmark Tax Reform Act of 1986. Then in 1997, again a clever name, but the Tax Reform Act of 1997. 2001, the Economic Growth and Tax Relief Reconciliation Act of 2001. And Viva Hammer earlier mentioned 2017 legislation, which was a substantial rewrite of the U.S. federal tax code. It goes by the clever name of Public Law 11597, and just as a to show you the some of the toxicity of politics in the United States, the name was stricken as a political tiff. So it actually was to carry the name of the Tax Cuts and Jobs Act, but in the final law, the name was stricken as part of a political fight. And I think that tells us all something in all countries about the difficulty of achieving consensus that I think can be the key to long run reform. So Emma, if you're still with me, let's jump to slide 13. Those four bills that I mentioned, I think in the United States, I would say have common to them, leading to their enactment, active engagement by our president. Now, of course, Australia is a parliamentary democracy, so I think the point that I want to emphasize in terms of a lesson to achieve a tax reform or a budget reform is that you need national leadership. In the United States, and I suspect that it is the same in Australia, the legislature or portions of the legislature cannot lead and effectuate a sweeping change on its own. The 1986 Reform Act was enacted in divided government in the United States. President Reagan, a Republican, faced a Democratic House and a Republican Senate, but there was divided government. It was the engagement of both sides of the aisle with leadership from the national leader which led to the ultimate enactment of that. 1997, Tax Reform Act, again, divided government. President Bill Clinton, a Democrat, faced a legislature in which both houses were controlled by the Republicans. In 1995, as a counterexample, when the Republicans first took majorities in both the House of Representatives and our Senate, Bill Archer, who is the chairman of the House Ways and Means Committee, often considered one of the most powerful committees in the United States Congress, said that his goal as chairman was to tear the income tax out by its roots, and he favored enactment of a value-added tax. The majority leader in the House of Representatives, Dick Armey, was in favor of consumption-based taxation and eliminating the individual income tax. At the same time in the Senate, there were actually powerful senators from each party that introduced legislation that would have instituted a value-added tax in the United States and significantly reduced the role of the individual income tax. None of that happened, and that was because each individual member, Bill Archer, represented Houston, did not drive the national conversation. The individual senators representing individual states did not drive the conversation. You really need national leadership. So my lesson number one to draw for, I would hope for Australia, is national engagement, national leadership toward the goal of reform. Emma, let's jump to slide 14 because that's really the big question. What's the goal? In the United States, again, the president, that national leadership, helped build a consensus around a clearly articulated goal. In the 1986 Tax Reform Act, Ronald Reagan had a campaign promise to lower individual tax rates and simplify the tax code. In 1997, Bill Clinton saw the Tax Reform Act of 1997 as part of a larger budgetary initiative, a major part of which was on the spending side to, quote the president, to end welfare as we know it. A large budget plan goal, reforming both the revenue side and the spending side. 2001, the Economic Growth and Jobs Tax Reconciliation Act. George W. Bush, in his campaign, had promised to return to U.S. taxpayers what was at that time, and you'll remember 2000, 2001 were coming out of a long period of growth in the 1990s. George W. Bush promised to return what was at that time a projected $1.3 trillion budget surplus to the American taxpayer. That was his campaign goal. He set an agenda, and it was an agenda that both sides of the aisle would have difficulty, anyone would have difficulty disagreeing with to one degree or another. 2017, President Donald Trump, his promise of his agenda was pro-growth policies, be they in tax, be they in trade, be they in regulation. Emma, let's turn to the next. So I think from those four experiences, a lesson that I'd offer is we need to build consensus around a clearly articulated goal. So I see the question for Australia is, what is the goal? I read the background papers, and you identify many, many problems. That's no different than a lot of other countries. Emma, turn us to slide 16. I'll offer some of the problems that the United States had articulated for it. And so I think there's a question of how many problems will you attempt to solve? In the United States, over the past, let's say, 5 years to a decade, policymakers have identified several policy targets as motivation for tax reform: stronger economic growth, international competition, complexity of our tax system and related compliance issues, income and wealth inequality, climate change, infrastructure finance, and for us, and I hope this is not a problem that Australia suffers from, the temporary structure of many provisions of our tax law. Emma, kick us to number 17, please. Let me call this lesson 2.5. In 2017, the Congress and the President emphasized two targets from that list, and I could have made that list larger: economic growth and international competition. This is not to say that those other goals were not meritorious, but there was bipartisan consensus on these two goals. Both sides of the aisle were exasperated at the slow growth that the United States has experienced in the 21st century and the pace of the recovery in real income coming out of the Great Recession from a decade ago. Also, members as far apart politically as Chuck Schumer of New York and Orrin Hatch, senator from Utah, argued that it was time to end the United States system of worldwide taxation as being an anchor, a drag against our international competitiveness. So a lesson I draw from this, from the 2017 experience, and I think we can go back and look at some of the commonalities to the earlier reforms that I mentioned, is that to have a successful consensus, you probably can't solve all the problems that face you, that your coalition that you will put together will start to break up. Emma, number 18, please. Lesson number 3, and this is straight classroom, classic tax analysis, political science, political economy, but it bears repeating. There are always trade-offs in policy design. Equity, a decision that's right for equity is not always right for economic efficiency. A decision that's right for economic efficiency is not always the right answer for simplicity. Equity does not always promote a pro-growth policy. There's trade-offs, and these trade-offs are going to define your policy design. So we're thinking of goals, we're thinking of policy design. We have to remember that there are trade-offs. Emma, let's go to 19. Let me illustrate some trade-offs. A fundamental, really kind of axiom is that to solve a policy problem, you need at least as many policy tools as policy targets. Within the broad goal of 2017 to provide incentives for business growth, the policymakers had several sub-targets. Weigh the benefits of domestic-only businesses compared to our multinationals. Weigh the benefits of corporations compared to businesses operated as pass-through entities, of which there are many. And just as a side note, in the United States, approximately 60% of business income is not earned in corporate form. Then weigh the benefits of domestically headquartered multinationals compared to foreign headquartered multinationals, essentially an inbound versus outbound question. Well, those were all additional policy targets that the members placed upon themselves, and they essentially had to create new tools, and the tools all involved trade-offs. So for example, to try to have benefits for pass-through entity businesses that were comparable to the tax reductions that the members were contemplating as a pro-growth measure for our large corporations, they created a special deduction in the individual income tax for income earned by individuals from these pass-through entities. There's a big policy trade-off in that, because if you were to read a lot of the legal and accounting press in the United States, you'll see much gnashing of teeth over the complexity that that regime creates. But it was to try and foster greater growth, greater investment, and the members had to trade off simplicity. To look at the benefits going to domestic business as opposed to multinational corporations, and the international competitiveness of those multinational corporations. The Congress instituted a one-time deemed repatriation of earnings that had been held offshore by U.S. headquartered multinational corporations to increase, at least in the short run, the relative tax burden on U.S.-based multinational corporations compared to domestic, solely domestic corporations, as the overall rates were lowered. And then to look at the difference between multinational corporations based in the United States and those based abroad, we created two new regimes. One's referred to as the GILTI, which you may have read about, particularly in the context of the OECD's Pillar 1. And GILTI, sometimes some of our colleagues on some of the other staffs, I think, perhaps spend up too much time coming up with acronyms for different provisions of law than maybe thinking of the substance. But just to make clear, GILTI stands for Global Intangible Low-Taxed Income. And another feature that was created to address partly the inbound side, but also partly the outbound side, was the BEAT. And since we have Viva Hammer participating in this conference, I'll tell you that she was the Joint Committee's sort of lead staffer in helping the members design and analyze and work through issues in the BEAT. The BEAT stands for Base Erosion Anti-Abuse Tax. New tools created, the BEAT, GILTI. They're not blows for simplicity. Section 199A, the special pass-through benefit that I mentioned, not blows for simplicity, but again, the trade-off of pro-growth or fostering better international competitiveness against another policy goal that you may have. Emma, let's go to the next lesson. If you could start from a budget surplus, and I don't think any country in the world right now is starting from a budget surplus, so you can probably take this comment just right off the table. But if you can start from a budget surplus, reform can be tax cuts or spending increases, and it's probably much easier for you to build a consensus. But even when there's a budget surplus, there's always a budget constraint. And budget constraints reinforce lesson 3 that there are always trade-offs. from the United States experience, let me emphasize a few points. The Landmark Tax Reform Act of 1986 was budget neutral, but actually it had a corporate tax increase which funded individual tax cuts. And that's what helped build the consensus. But it meant the further you cut individual tax rates, the higher you might have, the more money you might have to raise from the business side of the ledger. And that led to trade-offs of, are we simplifying? Are we getting growth solely from increasing incentives for the workforce? What about incentives for investment on the business side? The 2001 Tax Act, if you'll recall, I said that this was a case where President Bush said, gee, we're looking at a forecasted $1.3 trillion budget surplus over the next 10 years. Let's return that to the American taxpayer. Well, you might have think, where's the budget constraint there? This should be easy. Well, in fact, sitting in our perch at the Joint Committee on Taxation, where we're asked to estimate proposals and analyze the economics and law of them, members of Congress, in thinking of how they would take the president up on his challenge to return that $1.3 trillion in surplus to the American taxpayers, came up with more than $3 trillion worth of ideas. And so that meant there were a lot of hard choices because some members had to be told no. And the point I want to emphasize here is there's always a budget constraint. You've got to be cognizant of the budget constraint. It's important politically, and of course it then becomes important economically. Now in 2017, as Viva can attest, Congress granted itself $1.5 trillion over a 10-year budget planning horizon for a tax cut to work with. But again, just as in the case of President Bush's initiative in 2001, saying, here, there's room for 1.5 doesn't make it easy to fit all your goals into that fiscal box. Emma, let's go to slide 21. I gave this slide, if you're actually reading the slides, and I should digress just briefly to say the slides were really just for my talking outline, and I thought you might be kind of bored looking at me sitting here with a headphone, and you'd like to have some distraction. So I hope they're serving that positive purpose. I meant the title to be maybe a little bit provocative in that, do people understand the economics of the policies that we put forward? And do economists that propose some of the policies understand the people? I think this really kind of highlights another important lesson that I'll try and derive here that I think can be important as you tackle the challenges before you in Australia. And that's, do we as policy analysts communicate clearly? If we don't, have we not made it possible to enable our policymakers and the public to make reasoned decisions? I have found over the years that in public debate, it often appears that the anecdote prevails over data analysis. The anecdote also is often drawn from one tail or the other of the distribution of possible outcomes. And so I think that often means that while as policy analysts, we probably think most of the time we want to be designing policy for the mean or the median of the distribution of the population, we also end up paying a lot of attention to one tail or another. And often that brings us back to the trade-off that I was mentioning earlier, because when we're looking at issues in one tail of a distribution, it often raises a question of equity. And elected representatives, I think whether it be the Congress of the United States, Parliament of Australia, any of the European countries, often pay a lot of attention to the tails of the distribution. And when we try to design policy to hit both, let's say, the mean or median and satisfy tails, again, we're setting up multiple targets. And that means a lot more trade-offs we have to consider, potentially a lot more complexity, a lot less satisfaction with the underlying outcome. So let's turn to slide 22. Does poor communication and policy analysis constrain policy design? I think it does sometimes. Maybe this is not the case in Australia's parliament, but I find in tax debate in the United States that statutory incidence is confused mightily with economic incidence, and that ends up driving design. I'll give, clock's running okay here. I'll give two examples from my experience. In 1993, the United States Congress designed a broad-based energy tax. This was in fact never enacted. It was a very interesting exercise. As part of this, it was designed to basically be an excise tax on energy use. And so one of the questions was, where do we impose this excise tax? And you might think of that as, well, you know, we should do what's administratively simple. But what the members of Congress were presented with is basically every player in the energy industry asserted that the incidence, if it were to fall on them, would be borne by them, or that the economic incidence would be borne by them. So I sat in meetings with wellhead oil producers who said, no doubt the incidence of this tax would be borne by oil producers at the wellhead. The pipeline, the transcontinental oil pipeline industry, they swore the incidence of that tax would fall on them wherever it was imposed. The refiners, incidence of the tax would fall on the refiners. Our wholesale dealers, incidence of the tax would be there. Retail outlets, our service stations, that's where the incidence would be, members and staff were told. And of course, as economists, we thought there's clear evidence in the economic literature that long haul, you know, maybe not year one, maybe not year two, but the incidence was going to be on the consumer driving the automobile or drawing the electricity from the outlet in their home. And so I quipped in one memo that was drawn up for our staff at the time that based on the meetings that I'd been in, that the overall economic incidence of this tax would be easily 10 times the amount of revenue that would be collected, because each segment of the industry had clearly asserted and thought that they had demonstrated that they would bear the full incidence. Perhaps more recently, in our health reform efforts, our health reform legislation that was pushed by then President Obama, the Congress rejected including health benefits provided by private employers as income compensation, a form of in-kind compensation, as part of the income tax. Instead, they went with an option of creating an excise tax on the provision of insurance by health insurers, which, again, the economics would say has the same incidence. But many taxpayers said, can't include that in my income, the income inclusion approach, but we're okay with the statutory construction of taxing the insurance companies. Now, subsequently, I'll say, a number of people recognizing the economic incidence of it started a long-run lobbying effort, and even that excise tax was repealed just a couple of years ago. But again, there's confusion, I think, in terms of the economics as opposed to the statutory design. And I'd like to say, I think what that tells us is a lot of times because the confusion is what's reflected by the taxpayer, by the citizen, back to their members, that a lot of times we can have good economics, but it doesn't make good public policy, because good public policy is something that can stick and something that can work. And I'd offer as an example of that, maybe in spades, from 1990 in the United Kingdom. Some of you may recall that Margaret Thatcher proposed a poll tax, economic efficiency in spades, a head tax, complete efficiency, but it led to riots. So again, kind of a case where maybe the overall communication of the broader policy context in which this tax reform was suggested was not effectively communicated. So, Emma, let's flip to slide 23, since I'm pushing the time limit here for you folks. But what I'd like to say is that good reform need not be perfect reform. And what I've been trying to suggest in the last couple of thoughts is that effectuating sustainable policy, I think, requires communication, and that imposes its further additional constraint on the limits of understanding. We can turn to page 24, but that's really just, again, I want to thank you for having the opportunity to be with you today. I read the background material that you sent to me. A lot of challenges for Australia. Good luck in addressing those challenges. I hope my few remarks about political economy drawn from my experience are helpful when you step back and think about what you have to achieve, how you'll design it, and how you can achieve it. And again, great being with you today.
Tom, thank you so much. Really very helpful, insightful words on your experience as well as your extraordinary academic background. So we have a question here about the role of the United States in the current geopolitical international tax debates, and whether you think that the United States has a role and what role they can play given the conflicts between the players.
Well, you pointed out that I'm strictly nonpartisan, so I have to be really careful about how to answer that. Just to state the obvious, there's conflicts between the president and a number of the legislators. I think it's also clear that not everyone in the Republican Party is in complete agreement with some of the directions the president might want to go. And I think that highlights, back to the point that I made, that something that's successful really requires some consensus across a lot of different players. But as to the United States' role in the world, we're still largest economy, significant investments worldwide, significant international investments in the United States. I think it's important for the United States to be cognizant of concerns of other countries. Many members of Congress feel that way too. On a number of issues, the Joint Committee staff serves as the eyes and ears of Congress. At least as an observer status. We've attended a number of the OECD meetings discussing Pillar 1 and Pillar 2 in order to enable us to provide advice and analysis to members. So I know that's a bit of a wishy-washy answer, but my personal hope is that the United States stays engaged.
Great. Tom, everybody, you're welcome to send further questions for Tom into the system, but we're going to have to transition into the next panel. Tom, thank you very, very much. We really, really appreciate your time on a Sunday night in the hot Washington summer while we enjoy our morning in the cool winter. And we hope that you come one day to visit us and share your wisdom with us in person if any of us ever get onto a plane again. So
that'd be great. Thank you.
Thank you, Tom. I'm going to transition into the next panel in which we have several people from representing different parts of the economy and society and different age groups who all have an opinion about what the tax system should look like. The panelists will talk for a number of minutes and they will not be interrupted by anybody, just as Tom did, and then we'll have time for questions. So please, in the audience, please send us your questions that are in that. There's a box for that. And I will ask those questions when the panelists have finished. If you could address the questions to which of the panelists you want them to be answered by. We're not going to be able to have, unfortunately, as much round robin discussion as we would have in real life, but we certainly could have back and forth if you allow me to intermediate. So we have Danielle and Ellen, Cassandra, Sonia and Liam talking today. Their bios are in the packet. I'm not going to read them out, otherwise it would take half the time. But they're all esteemed people. What we're going to do is Danielle will start as giving us an economic perspective, following on from Tom's perspective, and then the rest of the panelists will talk in alphabetical order, not that you should think there's any bias here. And then after that, we will very much welcome questions on either their topics or, again, questions from Tom's presentation. So can I pass it through now to Danielle? I also want to say very much thank you to the PwC folks who are helping us out with this. We definitely couldn't do it without them. So, I mean, really a hands up and a clap to them for their technological support. Okay, so we're going to go into our first presentation now. Thank you so much again, Tom.
Fantastic. Thank you very much, Viva. I'm very conscious there is a lot to cover in 10 minutes, and certainly thousands of pages of ink have been spilled about the economic problems in the tax system, including by many of the people here today, and I'm sure all of you would be familiar with those key works. So I'm going to focus on what I think some of the biggest economic problems are. And I then want to pose the question why, despite the pretty compelling arguments for change, economists have made little progress in pushing forward the debate in recent decades. So I think today's tax and transfer systems largely reflect the world of 20, 30, 40 years ago when the major changes were last made. Significant changes have been few and far between since the GST was introduced in 2000. This has created structural problems, many of which are getting worse. And today I'm going to focus on three of those. So first, the system messes badly with incentives. Of course, almost all taxes distort incentives, but our system has some big distortions and ones that are difficult to live with. For example, we treat different forms of income, particularly savings income, very differently. Some savings vehicles like the family home, like superannuation, are taxed lightly or even subsidised. Others, like bank deposits, are taxed heavily. This means that investors are not always choosing the assets that best suit their risk appetite or liquidity needs. They end up making choices based on the nudge, or sometimes I'd say the push, that the tax system's giving them. So the retiree that sets up a self-managed super fund, investing entirely in bank stocks to chase franking credits, ends up with an unbalanced, unnecessarily risky portfolio. The lawyer who buys an investment property and takes out an interest-only loan is trying to maximise the tax benefit from the combination of negative gearing and the capital gains tax discount. Or the empty nester that sits there in their 4-bedroom family home to avoid stamp duty, as well as having to avoid paying any tax on their substantial nest egg. All of them are being pushed by the tax system into decisions that are neither personally nor socially optimal. Taxes on labour income distort decisions too. And despite a lot of hand-wringing about the decisions or distortions created by the top marginal tax rate, normally by well-paid men who are working full-time despite these complaints, the most punishing disincentives come through the interaction of taxes and welfare. There are some income traps for people on New Start allowance, and Cass from ACOS may have more to say about this, but there are also very significant disincentives for what we politely call second earners, by which we mean overwhelmingly mothers. New Grattan work that we're going to put out next Monday shows that right across the income distribution, second earners with young children face very high disincentive to work, particularly beyond 3 days a week, once the costs of childcare, tax and the clawback of family benefits and childcare subsidy are taken into account. So for a family where both parents are on $60,000 a year full-time equivalent, mother's working 3 days a week, she would take home a grand total of $2 an hour for her work on the 4th day and nothing if she worked for a 5th day. That is the thing that we should be wringing our hands about. Second of all, the tax system is leaky, undermining sustainability. One leak comes from the loopholes that allow people or companies to pay less tax on a given pre-tax income. I'm going to leave the challenges of corporate tax avoidance to the next session. But for personal income taxes too, the highly motivated and well-advised can significantly reduce their tax obligations. Remember the media's surprise when it was revealed that the 200,000 negative gearers had taxable income so low that they paid no income tax. How were they affording those investment properties? There are many options for would-be tax planners: salary sacrifice, catch-up contributions to super, family trusts, structures to pass off personal income as corporate income or capital gains. While most loopholes do have some reason for existing, although I am yet to find a compelling one for family trusts, Often the costs of the tax expenditures, both in terms of dollars lost and in undermining faith in the system, outweighs their benefit. The other major change to sustainability comes from the gradual undermining over time of important tax bases like consumption tax. GST collections have declined as a share of GDP since their peak in 2003-04. Partly that's because of the increase in household saving, but it also reflects the diminishing coverage of the tax. The share of household services subject to GST has declined from over 60% when the tax was first introduced to just over 55% in 2018-19. Similarly, fuel excise continues to decline as cars become more efficient and will erode further in the future as people make the switch to electric vehicles. My third point is that aspects of the tax and transfer system are unfair. Fairness, of course, is a thorny topic and one where economists will often fear to tread. We embrace instead the concept of horizontal equity, but even based on this relatively low fairness hurdle that people who are in the same circumstances should pay the same tax, the current system doesn't deliver. For example, a series of decisions over the past 2 decades, tax-free super retirement, refundable franking credits, special tax offsets for seniors, have created a system where someone's date of birth is almost as important as their income in determining how much tax they pay. An older household earning $100,000 a year pays on average less than half the total tax of a younger household earning the same. There is no policy justification for that degree of age-based segregation, and I'm sure Sonia from Think Forward will have a few more words to say about this. Another aspect of fairness is how we treat our most vulnerable. There is always a trade-off in the welfare system between incentivising work and providing a basic minimum standard of living. But we have zealously prioritised one and ignored the other for 2 decades. Since 2000, the unemployment benefit has declined from about 25% of median full-time wages to 20%. As a share of the minimum wage, it's declined from 43% to 38%. It is hard to imagine a much bigger incentive to work. But on living standards, the pre-COVID rate of new staff fails to deliver a basic standard of existence. It's 40 to 50 cents below the standard poverty line measures and bottom-up budget standards. People on Newstart are struggling to pay for essentials like rent, food, heating and transport, which is hardly the right state for them to be job ready. While it's designed as a short-term payment, 2/3 of recipients have been on it for more than a year, 1/5 for more than 5 years. And long-term recipients, as Cass will tell you, are more likely to be older, women and living in a regional area. If the current rate of job seeker reverts back, it will be devastating for the newly unemployed, but also for this group that have struggled with poverty for an extended period. I'm certainly not the first economist to make this point. Indeed, I think there is actually close to unanimity across a profession which is notoriously divergent in these types of views. But we should be vocal since it is economic arguments that are being used to justify the status quo. So to come to my big question now, why, despite the enthusiasm from economists and some in the media for reform to the tax and transfer system, has virtually nothing happened for 20 years? There are some obvious hurdles, quo bias, noisy losers, but I did want to make a couple of different observations. First is that people don't seem to find our much-loved efficiency arguments very compelling. The public seems to care more about the salience of the tax than its efficiency. So while to economists, swapping distortionary stamp duties for more efficient broad-based land tax is one of the most glittering prizes in tax reform, the public feels the opposite. Stamp duties, even in the tens of thousands of dollars, somehow are less of an affront because they coincide with a more expensive purchase and are simply added to the home loan. Whereas an annual land tax bill of a few $1,000s provides a regular griping opportunity. The answer is probably not repeating the same efficiency arguments louder, but trying to emphasise other arguments, still valid, that might resonate more. I want to say I think the New South Wales Federal Financial Relations Review did a really good job of this. On that one, it emphasised fairness, that the 1 in 20 people who buy a house each year are subsidising services for everyone else, including the 1/4 who've been in the same house for 20 years or more. I think there's also a case that economists should spend more time thinking about implementation with an eye to human behaviour. What are the transition mechanisms that could best mute any expected pushback? So for land tax, allowing some owners to defer payment until they sell their house would reduce the income stress for the asset rich but cash poor. A tax credit for homeowners who recently paid stamp duties could help reduce the screams of unfairness without resorting to risky, very long-term transitions. Which brings me to my second point. Realistically, tax reform needs to be bought. Historically, tax reforms, the Hawke government ones in the 80s, the Howard GST changes, the Gillard government carbon price, all came at a net cost to the budget, at least in the short term. Buying tax reform helps compensate the losers and ease the transition by making change more palatable. Given the tight fiscal straitjackets that Labor and coalition governments set for themselves post the global financial crisis, there has been little money to help the medicine of tax reform go down. That was why I was surprised, actually, that more tax reform enthusiasts didn't come out against the government's stage 3 income tax cuts. Beyond the absurdity of locking in major tax changes 6 years in advance, given anything could happen to blow the budget in the meantime, and indeed it has, the big downside was always that they gave away significant amounts of revenue without using it to buy permanent changes to shore up the tax base. My concern was that those huge cuts would eliminate the opportunity to buy meaningful tax reform for at least a decade. That concern hasn't changed, although I am a little more optimistic that COVID may open the door once again for some tax reform. There are a couple of promising developments. I think the first is goodwill. I've been looking at the data on trust in government since 2016, and the recent data is really the only time I've ever seen those numbers going up. People are placing more faith in institutions, and particularly federal and state parliaments. So governments do have political capital, and I hope they use it to do something important. Secondly, I would argue that the upfront fiscal constraint, the sort of the sticker shock from reform, is now less of an issue. Macroeconomists are telling us that the government might have to spend $100 billion over the next couple of years to avoid a period of extended high unemployment. In this world, some of the glittering tax reform prizes could finally be possible. Whether it is the stamp duty land tax swap, a broadening of the GST base, or a cash flow tax for corporates, reforms that require both political capital and willingness to bear an upfront cost could finally be on the table again. Thanks, Viva.
Thank you. Are we coming up next? One, you want to go?
Yes, great. Hi, everyone. I'd just like to acknowledge before I start off that I am on the land of Noongar people here in Perth and pay my respects to their elders, past and present. Danielle, I love that you brought up the young person's perspective already when it comes to tax. When I think about young people and tax, a particular photo comes to mind. It's a photograph from the Sydney Morning Herald. You might have seen it. And it's of an older man with grey hair, standing with fists raised, mouth contorted in rage at the franking credits inquiry in Chatswood. A week later, another photograph was published to the Sydney Morning Herald of a different protest. This time it was of school children protesting inaction on climate change. I always think about the contrast in these pictures when I think about the tax system. Here's an image of a man fighting for what he believes in, which is the tax concession he believes he's entitled to. And here are kids fighting for what they believe in, the survival of a planet that they have to live on for the next 100 years. Those kids have no idea what a franking credit is. I'd imagine most 18-year-olds don't. And not because they're all too busy fighting for climate change or dancing on TikTok. It's because they're too busy joining a uni or working part-time or hanging out with friends. And you know what? I reckon that man in Chatswood didn't know what a franking credit was when he was 18 either. When he was 18, he trusted people older and wiser than him to put in place systems to safeguard his future. So when we talk about tax and young people and tax reform, we need to be asking that question. What are we putting in place today for today's 18-year-olds? Today, I would like to posit the argument that there is value in intergenerational fairness as a guiding principle in tax reform. Danielle has written extensively about the generational bargain. This is the implicit contract that underwrites our tax system, where younger generations work so that they can look after their elders and those who come next. This is on the assumption that generations after us will do the same. But economists and experts have been warning that this generational bargain is under strain due to distortions in the tax system. And the economic fallout from the pandemic makes this worse. We know recessions hit young people hardest. The unemployment numbers out of the ABS in June was 16.4% for youth unemployment. Economic scars born early in a career cut deeper than those later in life. So losing one's job is estimated to result in a 20% fall in lifetime earnings, with research suggesting that wages are still lower 20 years later. Last week, the Productivity Commission found out that wage growth has flattened or even slowed for some young people. This is all in the context of the great Australian dream of home ownership looking further away than for most. To get out of the crisis following the pandemic, the government has necessarily spent. I'm sure today we will touch on whether this spending was enough or too much and whether MMT means we never have to worry about it. But regardless of people's positions on stimulus spending, once the crisis is over, the government will address structural problems. And if we can't sustain growth under the current tax system, this will fall on young working age people. And so what's wrong with the current tax system for young people? Well, Thomas talked about the trade-offs we make in tax reform. And in Australia, these trade-offs has been at the expense of the young. We've already spoken about the over-reliance on income tax. Those who earn a living from investments, generally older, established Australians, pay a lower rate of tax than those who work for a wage. The leniency with which we currently tax superannuation has distorted the tax system and left the federal budget bereft of billions. What Danielle described as a leaky tax system, tax concessions and incentives, the seniors and pensioners tax offset, for example, or the beloved franking credits of the man from Chatswood, who I spoke about earlier. So how do we get here? What are the drivers of the problem and why is it so difficult to reform out of them? I have a few ideas. First and foremost, we can't talk about the tax system without talking about demography. Demography is destiny. There will be fewer working age people for every person over the age of 65 to pay for the running of our society. The number of working age Australians for every person over 65 has fallen from 7.4 in the mid-1970s to a projected 3.2 in 2055. And take note, this projection was modelled on previous immigration levels, which we know will be impacted for a number of years following the pandemic. This means things are even bleaker. When we talk about intergenerational inequality, what we are also talking about is redesigning our economies to suit 21st century lifespans. We inherited our tax system from a time when 4 generations lived and worked together. However, thanks to longer life expectancies, we have the largest number of generations living and working together than ever before. In Australia, the disruption of longer lifespans is exacerbated by a low birth rate. Longevity is a good thing, don't get me wrong, but it means we need to update our systems, such as tax, to look after more generations at a time. Demographics is one. Another reason we've got into this position, and it's difficult to get out of it, is that politicians want older votes. Though negative gearing and the abolition of refundable franking credits are accepted by economists as sensible progressive tax reform, successive governments have lived in fear of upsetting the larger cohort of older voters who have grown accustomed to them. But I don't believe older voters are purely self-interested. I think we can appeal to their love of their children and grandchildren to get the broad-based economic and tax reform we need. As John Hewson opened today's discussion with, was his point that we need to build consensus and start talking about justifications for tax differently. We've noted that Danielle said efficiency hasn't been persuasive. This is where intergenerational fairness comes in. Research has actually shown that people are more likely to be persuaded based on appeals to the long term than appeals based on ideology. So if we are trying to encourage the public and politicians to think beyond their tribal instincts and adopt more equitable tax system, a more persuasive approach could be appealing for change on behalf of future generations rather than poor within their own generations. Another reason we have this imbalance or an ageist tax system are tightly held notions of the worthy poor. When you think of, when you're asked to think of a worthy poor person, many people might think of an old lady crouched over a walking stick hobbling along. Now, this lady is in need of help through a pension system, an aged care system, and a health system. The problem is that there is a whole generation over the age of 65 using that old lady with the walking stick as an excuse to keep age-based tax concessions. That old lady doesn't have franking credits. And when you look at the economic evidence, it becomes clear that old age is no longer a proxy for the worthy poor. Another great point that Thomas made in his speech was talking about the communication and understanding in the public. The way we talk about tax is deliberately difficult, so young people are locked out of conversations that are important to their future. And importantly, Thomas said this constrains our ability to make good economic policy. When I talk to my friends, before I can even finish the words refundable franking credit, most of them are asleep. But this shouldn't be mistaken for the fact that there is a growing resentment towards older generations. Yes, we haven't had a strike for tax reform. I keep bringing this up with my Think Forward colleagues, and they tell me that it would just be me alone with a megaphone and a sign. But the protests we do see about climate change and racial justice are born from the same mistrust in older generations acting without regard to young people's interests. So what do we do about these problems and barriers to overcoming them? Well, I co-founded Think Forward because Australia needs economic reform that takes the interest of younger generations seriously. Today at the National Tax Summit, we have the opportunity to discuss once-in-a-generation tax reform to make our society more equitable and sustainable. You need to think about the youth of today and future generations when you discuss tax, whether that's corporate taxes and imputation systems, how we determine assets tests, reforms of tax settings that inflate demand for housing, or even if there is scope for tax concessions for young people in the superannuation system. When this summit ends, this issue doesn't, so it needs to continue into the halls of Parliament. And that's why I Think Forward is calling for a federal parliamentary inquiry into intergenerational fairness. Look at what they've achieved in the UK. Following the global financial crisis, which really hurt their young people, persistent lobbying by a group we partner with, the Intergenerational Foundation, led to the Parliament establishing a committee on intergenerational fairness in the House of Lords. The committee's recommendation included the removal of outdated benefits based purely on age, in our case, things like the SAPTO, or required the Treasury to publish the effect of annual budgets on different generations. And actually this year, a Future Generations Bill was introduced in the lower house of Commons. We need to be considering similar reforms in Australia. Over the next few months, Think Forward will be reaching out to organisations across Australia, including many of you today, to get your input on the terms of reference to make sure we are asking all the right questions about tax reform and the economy as a whole, and to seek your support in advocating with senators to establish an inquiry. But for today, during this summit, I hope you will all apply an intergenerational way of thinking and imagine what our tax system will mean for future generations. Thank you.
Thank you so much. Thank you so much, Sonia. And I'm going to call on Cassandra now to follow her.
Thanks, Beaver, and fantastic, Sonia and Danielle, to hear your perspectives. Look, I'm feel very honoured to be a part of this panel, and I want just to acknowledge that we are variously on the land of First Nations people and pay respects to Elders past and present, and to acknowledge that in the last week First Nations leaders came out with their serious call again for closing the gap at the very front line of huge equity issues in our country. And of course, the outstanding question is how we properly resource that work. I also want to thank John and ANU and TTPI for the opportunity to be involved in this really important discussion. It's also the start of Homelessness Week, and again, as we get into discussions about tax, at the heart of, Sonia, the picture of the person that you described, that older woman, it will be about housing, the most acute risks that she will have faced. We know that it's older women who are our largest growing group of people who are faced with homelessness. And gee, if there's ever a time for us right now to finally end homelessness in Australia, it would be in the face of this terrible health crisis. So this is a very important discussion. Those who know ACOS know, those who know me, my colleague Peter Davison, who works on our tax agenda, that taxation is not a boring topic for us. It's actually one of the most important things that we spend time looking at, considering, because we know that actually paying our fair share of tax is our greatest act of love and care. And particularly right now, I think we're really confronted, of course, by what it looks like when we haven't invested enough or appropriately in critical care services like our aged care sector. So it's so important that we get this discussion right. In our view, I just want to highlight a few things. Right now, our priority must be our confronting of the pandemic and the health risks, and also protecting and generating jobs and income. As we've ever learned lessons from the past, including in the context of our response to the GFC, if we don't get it right, once again, we will have that reality that it will be older, white, male people in the community who will typically do best out of shocks like where we've seen in the past and we're experiencing right now. And it will typically be women, children, young people, people on lower incomes who are hit first, hardest and worst by these kinds of crises. I do want to highlight, though, that there is no what I call magic tax solution. Tax is a very important agenda, but what we've got to do right now, in our view, is make sure that we are spending and spending very well. We're razor sharp on what we do to protect communities and to generate jobs and protect incomes as safely and as quickly as we can. I think it's really important. I'm hoping that today we will hear a broad consensus that it is crucial that we do strengthen our tax base. It is important that we make sure that we are set up well for the future. And Sonia, I couldn't agree with you more about having a whole of life cycle, a whole of understanding about intergenerational consequences of every decision that we make. I know that there are going to be debates about the tax mix today, and I want to come back to that because I want to make sure that we don't descend into a debate about that kind of agenda when actually there are some much more obvious and compelling tax agendas that we could pursue at the right time in order for us to respond appropriately to this recession, to understand the scale of the consequence if we don't get this right in terms of the right investments available for people who really need our support, and the longer tail of generational issues, and also the tackling of climate change and making sure that our tax system is contributing to moving as quickly and as rapidly as we can to zero carbon emissions. That's a huge brief, right? So let me just touch on a few things and then maybe just to conclude, I'll also talk about realities, because we certainly have been involved in many efforts to try and secure positive tax reform, and here we are again talking about many of those changes without having made the progress that we would like. So as I noted, I think it's really crucial that we are focused on stimulus on the spending and investment side of the economy right now. And Danielle, I want to thank you again as an economist and many other economists who have highlighted how crucial it is that our transfer payment system, most notably the job seeker payment, is set at the right level. We need a permanent, adequate increase on that front. It is absolutely one of the most important things we can do to protect people in the context in which we're now, with facing serious and potentially very long-term unemployment experiences for some people. And the second area of investment is crucially our care services. I don't think we should be right now obsessing again about debts and deficits. It was a bereft debate last 10 years, and here we are again, knowing that in the context of the Australian economic conditions generally, government can borrow long-term at less than 1% of interest. So if we get the recovery strategy right, we can definitely, as many economists are saying, grow our way out of debt. But there is much that needs to be done to strengthen growth and improve its quality in future in terms of our productivity and our social and environmental gains, as I highlighted already. In our view, there isn't a quick tax fix for the immediate challenges. we are a strong voice against any notion of bringing forward the stage 2 of personal income tax cuts. That is estimated it would be costing the budget $12 billion if we did that. We don't support that stage of personal income tax cuts at all. It's the last thing we should be doing. We're looking to support consumer demand. We should be putting more hands in the dollars of people on low incomes, including raising the rate of job seeker for good, not giving tax relief or putting more dollars in the hands of people who we know from all the analysis about spending patterns at the moment, if you've got any capacity to save, that's actually what you're doing. And we think that those kinds of tax cuts should be dropped from the agenda at this time. If we're to succeed in containing the virus and unemployment, and we are then getting a trajectory of reducing unemployment, then our view is that will be the time for us to turn our again to some of the structural problems that we were grappling with before COVID. In this group, many of us have been involved in understanding what was happening to sort of sluggish economic growth pre-COVID, and as we have noted in the past, as in the early 80s, if we can forge a political consensus about an economic strategy that would work and that benefits the vast majority of people with a sense of equity at its heart, we do believe, again, that a more ambitious reform agenda is possible. I think I just want to highlight, in case we miss this again, that Australia is overall a relatively low taxing country in the OECD. It was the 8th lowest tax country in the OECD as at 2018. It is really important that we do consider how we're going to strengthen our public revenues without harming equitable economic growth. As many from the multinational institutions such as the OECD and IMF were highlighting, if we were to be focused on strengthening economic growth, then at the heart of that was to be lifting up the incomes of people in the bottom 40% of the community, that is the engine room of a real economy. And again, what we're seeing in terms of the government's investments in the face of the economic crisis right now, that's exactly what's happening, that people on lower incomes are spending the dollars available to them in contrast to people on higher incomes. We completely accept that how we tax is as important, however, as the level of tax. We do agree that the present system is far from fair and efficient. There's no question that some of the biggest weaknesses in our tax system includes if we put this politely, the inconsistent taxation of investment incomes. Yes, let's talk about negative gearing, let's talk about capital gains, let's talk about superannuation, and actually continue to forge ahead with very broad consensus that has been there in the past. And I don't think we should shy away from understanding that there was a lot of consensus for reforms in those areas, even in the context of what happened with the previous election results. Secondly, and highlighting that we do need to make sure that our tax system are not distorting critical investment decisions that we're going to need to get right into the future. We're going to get the kind of economic growth that we are really wanting to secure. Secondly, a narrow and inefficient state tax base is a huge problem. Where, again, Danielle and others, yes, we are absolutely up for the work that would be done for us to move from and away from a heavy reliance on stamp duty towards a broad-based land tax. We've previously brought together broad consensus on that reform. We've brought that through to federal and state governments in the past. Here we are again, and I do think that this is an area of high priority because of the significant issues around the efficiency of a land tax base, understanding that there is significant benefits to be gained in terms of housing investment decisions out of that kind of reform. And third, avoidance and evasion by people on higher incomes. Yes, family trusts, Danielle, discretionary trusts, private companies. The fact that these kinds of tax arrangements are enabling people on higher incomes to be able to effectively reduce their tax bill, in many cases to zero. And it is simply not sustainable, nor is it fair that we're allowing those kinds of tax treatments to continue. And so in our view, that should be a top priority for us to broaden the personal income tax base. I want to just highlight a couple of areas where I think in the context of the political environment in which we're confronted and the very real health, economic and social crises, I think we should be looking to secure broad consensus at the right time in terms of the tax agenda. Quite clearly, there is a new and very acute concern about our care services and including in our aged care services. And in recent past and again today, I want to highlight that we don't think it's sustainable for us to have a very low proportion of people over 64 who are paying income taxes, and that the tax treatment of our very important superannuation funds is not where it should be. And we would particularly urge us to look at the taxation of earnings and to see whether we could bring in a sensible taxation of those earnings, explaining that a critical reason for doing that is for us to be able to properly fund our health and care services, including for people who are older in Australia, who particularly increasingly will need reliance on that. And the other area we would again highlight is the way in which our Medicare levy is structured, that because of the way that there are large sort of holes in the base of that Medicare levy, because of the way that people are able to shelter their income taxes, that people are on higher incomes are not paying their fair share into the Medicare levy. And again, by articulating the reason for moving with those kinds of reforms is for us to fund critical health and care services, including for people who are older. We think that that is a way for us to help to explain the why, not, as you say, Jenny, all those kind of drier efficiency arguments. And Sonia, I think that when we look at what really strikes at the heart of fear and concern for younger people, as well as increasingly people over the life course, is that deep insecurity that comes from a sense of never being able to secure your own home, or at least a secure place to live. And so that bundle of housing tax concessions, I can't understate again how crucial it is that we build again fresh support for reform in that area, that we articulate that why we are tackling negative gearing and capital gains is for us to continue to invest big in public, social, affordable housing and making sure that housing becomes affordable for everybody really again would, I believe, in the face of the how strongly people have understood how at risk you are if you don't have access to a home, then this is really, for us, something which shows the vulnerability of so many people. And again, I think that's an area where we could build. It's not easy, but it's the kind of consensus that we need. And look, Danielle, I want to thank you for bringing through again these sort of what I believe are sometimes quite spurious arguments about marginal tax rates and sort of disincentives to participate in paid work. You're quite correct that one of the most acute concerns we've got is the way in which the tax and transfer system impacts on lower income earners, and that if we were to ever do some serious work on getting that right, then we would lift up the participation rates over the longer term, including for lower income people, including for women, and rather than suggesting top marginal tax rates is the big issue. I want to highlight again, finally, just to say, because I'm very worried about it, that this kind of goading of us bringing forward the income tax cuts stage 2 and stage 3 still legislated would be deeply damaging. we're deeply damaging to our communities. We know that in the face of this pandemic, it's people on lower incomes, people who are more vulnerable, who are really at the front line. And that kind of tax reform, the only thing that it will do is put more dollars in the hands of people who have jobs and have high and it will deeply damage our tax base in order for us to create a sense of hope and optimism about a better future for everybody. Thanks very much.
Thank you, Cassandra. And I'm going to pass it now to Liam.
Thanks, Viva, and thanks, Cassandra. I couldn't agree more, in particular with that last statement. And I'm going to pick up on some of those themes and issues and cover off in my discussion as well here. Firstly, I'd also like to acknowledge traditional owners in the land on which we meet across the country and pay my respects to elders past and present. And I'm here to provide, I'm Liam O'Brien, I'm the Assistant Secretary of the ACTU, and I'm here to provide the perspective of working people in relation to tax reform and the challenges coming out of COVID in terms of a health and economic crisis. And whilst I agree with many of the issues that are raised by my fellow panellists, I really want to focus on the situation in Australia with respect to income and wealth inequality and the role that tax plays in addressing it. Specifically, I would offer that to address rising inequality and to invest our way out of the current economic crisis, it is essential that corporations and the very wealthy pay their fair share of tax and we move to a broad-based tax reform. For context, Australia's experienced the worst economic crisis since the Great Depression. Millions of Australians have lost their jobs or had their hours cut. Arguably, COVID as an economic crisis represents the greatest demand shock the Australian economy has ever experienced. Consumption has not only been weakened, in many cases due to health restrictions, it has effectively been prohibited and is likely to remain restricted in the months ahead until we're able to develop and distribute an effective vaccine or discover significantly more effective treatments. We know that in the months and years ahead, we are going to require significant fiscal measures to support the recovery of our economy and to ensure that job protection and secure job creation are central to any plan. We know that this will require more, not less, fiscal effort. Inequality and poverty, which were rising prior to the pandemic, are now accelerating at an alarming rate. Women and young people, to Sonia's point, are bearing the brunt of this crisis and have been disproportionately impacted by job losses. Whilst income inequality and the role that tax plays in moderating and correcting for it are going to be critical in the years ahead, what is often overlooked in the inequality debate is the significance of wealth inequality in this country. Wealth inequality, which is even more significant than that with respect to income, is accelerated and exacerbated by our current system. To put this into context, we should just consider the fact that prior to the pandemic, the richest 1% of Australians had more than double the wealth of the entire bottom 50%, or more than 12.5 million people. Moreover, the top 1% of Australians, just 250,000 people, owned a staggering near $1.6 trillion US, equating to about 22% of the nation's wealth. This alone demonstrates that there is still serious economic inequality in Australia. Many of these individuals have a myriad of ways in which they can structure their affairs to pay little or no tax. And this is important in the context of this discussion. And today I want to ask the questions. Are Australians comfortable with our failure to sufficiently cover the necessary capital basis, including corporate taxation and wealth accumulation, and limit the loopholes for corporations and the wealthy to avoid their obligations to society? This leaves working people through taxation on wages to shoulder an increasing burden in our system. And I want to offer that I don't believe Australians are going to accept that going forward. Because for working people, all of this highlights to us that to get out of our first recession in 30 years, Australia must consider a broader tax base than we have now. To address rising wealth and income inequality, we need to move to a more even playing field, and it is essential that corporations and the very wealthy pay their fair share of tax. In the recent past, governments in Australia have not had the political courage or confidence in the Australian people to make the case for tax increases in particular areas. Consequently, our tax base remains less than optimal because we've allowed multinational corporations and the very wealthy far too many opportunities to avoid contributing their fair share to the public purse. We need, to Cassandra's point, We need public investments which create jobs and serve the current and future long-term needs of Australians by investing in quality private and public sector jobs, high-quality education and research, transport, communications, renewable energy infrastructure, and research and development that will enhance innovations, the use of new technologies, higher productivity and new export industries. And to pick up on some of the other issues, we need a strong social and community service sector. We need to ensure that we have free childcare so that many of those that have been displaced from work can re-enter the workforce easily. However, public investments of the scale required are not possible with our current tax base. Australia continues to have shares of tax revenue and public spending in GDP which are amongst the lowest in the OECD. This government has lacked the political courage to tackle unproductive negative gearing and capital gains tax concession, which disproportionately benefit the wealthiest Australians. Rather than closing corporate tax loopholes, governments in the last few years have proposed billions of dollars worth of tax cuts to corporations. The government's own modelling shows that this will deliver only modest, if any, benefits, and even this will take many years to achieve. The failure to implement sensible tax reform is costing the government billions of dollars in lost revenue that is desperately needed and required to fund the type of investments Australians deserve. The purpose of our tax system is to generate sufficient revenue to provide the services the community expects, invest in our future prosperity, and support a society with decent standards of living. The ACTU has identified billions of dollars in extra revenue from tax changes, including clamping down on multinational tax avoidance, introducing a Buffett rule, which requires all Australians to pay a minimum tax contribution. This tax revenue is critical to the quality public services and investment in our future economic prosperity. We've also set up 5 key principles on which we should base any tax reforms. Firstly, in relation to Australia has a revenue problem and not a spending problem. Australia is a low taxing nation. Almost all other developed nations' governments both spend and raise more as a share of GDP than Australian governments. This has been highlighted in the relative evidence of our government with respect to other comparable nations. Rather than the often pronounced spending problems, which has resulted in arbitrary speed limits placed on tax to GDP, the long-term challenge to sustainability of public finances clearly are the result of a revenue problem. Government revenue as a share of GDP has steadily declined over the past decades and has significantly impacted our ability to not only respond to this crisis, but also meet the future needs of Australians. Australia's total tax revenue as a percentage of GDP is well below the OECD average and has one of the lowest share of tax to GDP in all of the OECD countries. Secondly, we need a system that is more equitable. Not only do we collect less tax than the majority of other OECD countries, our system is increasingly inequitable, with those with high incomes paying a smaller and smaller share of taxes over time, while receiving a bigger and bigger share of income. Like Cassandra, we oppose the bringing forward of these stage 2 and 3 tax cuts. Australia has tax concessions which are not available to the same extent in other high-income countries. Measures specific to Australia include those pertaining to capital gains, negative gearing, superannuation and trusts, just to name a few. These are used disproportionately by high-income earners to further reduce their taxable income. This not only deprives us of the much-needed revenue, as previously stated, it accelerates income and wealth inequality, which both impairs our public finances and tears at the fabric of democracy and our society. As an example, 73 individuals in 2017-18 who received more than $1 million in income paid no income tax at all. This violates Australians' notion of a fair go, and the government should act to close these loopholes to ensure a sustainable revenue base for the necessary investments the government must make in terms of economic reconstruction. Thirdly, we need a broad-based tax reform as future demands on government will grow and not shrink. The increase in the scope and volume of services for the community and the long-term commitments. Australians, however, do not support cutting programs to meet the future demands. Such austerity is not only unfair, it is likely to shift these costs to lower income people, thus increasing inequality and stalling economic recovery. To maintain these services and meet the future demands on government, progressive, broad tax reform is urgently needed to increase revenue and to ensure we can continue to meet the growing demands on services. This includes addressing the myriad of concessions available to wealthy individuals and ensuring that all tax bases are treated appropriately and equally. This will also ensure we eliminate arbitrage opportunities available to many individuals who are able to structure their affairs to minimise their tax payable. Fourthly, we need to be able to fund the type of society Australians want, need and deserve. Policy settings must secure sufficient revenues to enable all levels of government, and I agree with what Cassandra said in regards to states' narrow and inefficient tax bases, but to fund all levels of government for the type of society that Australians want, need and deserve. This includes universal access to public goods such as health, education and welfare, and a decent social wage. And finally, we need tax reform to create a more equal society. We need to tackle rising inequality and create a more equal society. We must recognise the critical role our system plays in terms of distribution of income. This is essential not only for equity, but also for economic recovery. For too long, prior to the pandemic, we have had a sluggish consumer in Australia. 7 years of stagnant or falling real wages is holding back economic growth. A fairer income distribution and decent living standards will generate higher domestic consumption and provide a boost to local businesses. Entrepreneurs will respond to higher demand for their products and services by investing in production and taking on more staff. The stimulus effect of a much-needed real pay increase for Australian workers will far outweigh the impact of cutting corporate taxes. Given the recent health and economic crisis, global geopolitical events and the heightened uncertainty about the future of the global trading system, it makes sense to support these highly geared sources of domestic economic growth. Decent and more secure jobs that pay a fair wage is a key ingredient of a sensible and balanced economic strategy in today's challenging global environment. But this is only possible with fundamental tax reform. In summary, these are just 5 principles that Australian governments must embrace with respect to taxation. They were necessary before the pandemic and they are unavoidable now. I hope that throughout this summit you also consider the plight of working people and the role that our tax and transfer system plays in addressing inequality. I want to thank the ANU and everyone for inviting us to participate and hand it over to the next speaker. Thank you.
Thank you, Liam. Thank you very much. I'm going to pass it now to Ellen, and Ellen is going to be our last formal presentation, after which I will address questions to the panelists. So please send through your questions. We have quite a few. We're going to finish at 10:30. So please pass through your questions, and then after Ellen, we'll get to them. Thanks, Ellen.
Thanks, Viva. I would like to start by acknowledging the traditional owners of the land on which we're meeting around Australia and their elders past, present and emerging. So I'm going to be talking today from the tax practitioner's perspective, which is not an economist perspective. It's more a practical, what do we see in practice in terms of being important tax. I'm going to talk about 3 areas. First, the corporate tax rate. Secondly, a few taxes that are really important to investing, which I think are overly complex and uncertain. And thirdly, and perhaps most importantly, the digitalisation of the economy. So first, the corporate tax rate. It is high by international standards. So Australia has a high reliance on personal income taxes and corporate income tax. And more than 2/3 of the Commonwealth's tax receipts come through these taxes, which is more than twice the OECD average. There are many businesses that are calling for a lower corporate tax rate to increase investment, jobs and wages. In a post-COVID world, Australia will need to consider whether it should broaden the types of taxes it relies on collecting and reduce the corporate tax rate. We did have a debate about what the appropriate corporate tax rate was in 2018. However, this debate got lost in the technicalities of modelling different outcomes and broader community concerns. To give a bit more international context to Australia's tax rate, when Australia went from a corporate tax rate of 36% in 1995 to a rate of 30% in 2001, we led the OECD down to that rate. However, since then, other OECD countries continue to drop their rates. OECD member states have an average statutory corporate tax rate of approximately 23.5%, and in Europe, the regional average is about 20%. So we are out of step with our international peers, and this can cause challenges in attracting capital to Australia. Our high corporate tax rate, in part, reflects the fact that we do not tax key parts of the economy, such as resources and financial services, effectively. For example, we've failed to establish an appropriate resource rent tax. We tax inputs to mining through various state taxes and impose significant royalties at the state level. Our dependence on corporate taxation in particular will be for a number of reasons. First, many businesses will have losses which will be carried forward and used over. We saw corporate tax collections drop significantly in the years after the GFC, and we would expect that to occur even more so post-COVID. Another challenge for Australia is that there has already been a lot of reform in corporate taxation since the GFC. After the GFC, budgets were pressed and there was a big push to tighten the corporate tax regime around the world. The OECD suggested a number of measures be introduced, such as anti-hybrid rules. Australia has generally acted quickly in adopting these tax rules. Australia has a very detailed disclosure and review law regime and has significant resources allocated to pursue corporates and high-wealth private businesses. So this time in the COVID-19 world, there will not be any low-hanging fruit in terms of corporate tax reform that is available to expand corporate tax collection. A further point is that competitive neutrality will be incredibly important in terms of attracting capital investment. At the moment, different rates of taxation can apply to an investment. For example, corporates need to compete against super funds which have a tax rate of 15% and can access franking credit refunds. And non-resident lenders often do not pay any tax in Australia due to exemptions for interest withholding tax and non-land-rich assets. The TTPI has done a really good public discussion about the taxation savings in Australia, which my other panel members have referred to. I think what tax rate should be applying to all types of investment. At the moment, reducing the corporate tax rate seems to be off the table politically. Instead, we're seeing investment allowances being introduced to effectively lower the tax payable. An investment allowance can definitely motivate spending by business, but it tends to benefit corporates with high capital expenditure and tax payable in the current year versus businesses with significant employee costs. For example, sectors such as hospitality, tertiary education, IT and medical sectors. Unclear whether both sides of politics would eventually get to a point where they can support a corporate tax rate cut. Labor has recently said that it does not support a rate cut because it doesn't agree that trickle-down economics would result in increased employment opportunities. Having said that, we've seen during COVID a big push to get more money into businesses through cash flow boosts and job keeper. It might be the case that being in a recession means that there's more room for consensus in supporting business and investment through a corporate tax rate cut. The second problem in the Australian tax and transfer system that I would highlight is that there are many taxes that are important to investing which are overly complex and uncertain. I'll call out three to demonstrate that point. There are many more examples. The first one is transfer pricing. Transfer pricing is a highly grey area of law. It's very fact dependent and it's often difficult to find directly comparable transactions that can substantiate transfer pricing position. For example, in the ATO's streamlined tax assurance reviews that it's been conducting, high level of assurance in relation to transfer pricing in approximately 75% of the reviews undertaken. That is most likely a reflection on the limited time that the ATO had to complete the reviews, but it is also indicative of the difficulties involved in establishing whether a position taken by a taxpayer is reasonable. There has been a recent focus over the last 4 years or so on related party debt. Uncertainty over the treatment of related party debt is problematic in terms of providing foreign investors certainty in relation to investments made in Australia and ensuring that there is competitive neutrality. A simple statutory safe harbour is an obvious solution. Another aspect is in tax obligations. An employer needs to consider multiple taxes regarding employees, including payroll tax, FBT, super guarantee and workers' compensation. These taxes arise at different levels of government, state, federal and international. There can be significant permanent establishment risks for a business if an employee is working outside Australia. The OECD takes the position that having an employee work from home in another jurisdiction can cause a relevant nexus to taxation in that country. That concept will be really interesting in a COVID lockdown world where employees might be working anywhere in the world. If taxation of employment was more streamlined and simple, that would make a difference of doing business in Australia, including potentially better supporting the gig and sharing economy where there are a large number of independent contractors. It's not mentioned in stamp duty. Stamp duty is another example where you need to consider numerous states and different rules and deal with different revenue authorities. It requires valuations and an understanding of sometimes complex legal issues, such as what is a fixture, which can be really difficult to get your head around if you're looking at wind turbines or other specific assets. Essentially, stamp duty is a transaction. The third area that I'll mention, this is the final area, is the digitalisation of the economy. How we respond from a tax perspective to the digitalisation of the economy is still open to debate. This is an issue of significant community importance and trust. The international tax rules were designed, when they were designed, global trade was limited and the digitalised economy did not exist. The current taxation nexus rules, which set out how countries allocate taxing rights, do not adequately capture online transactions or web-based businesses in the same way that they capture bricks and mortar businesses. Australia undertook a consultation process in 2018 to explore options to move towards a fairer and more sustainable tax system for the digitalised economy. However, after community consultation and further international development, decided to await the OECD's work plan on this issue rather than have Australia introduce its own unilateral regime. How we respond to the digitalisation of the economy needs to be resolved to restore trust in the community in relation to the taxation of businesses more generally. It's a complex challenge. Even defining what types of business and transactions should be captured is open for debate. How we address the digitalisation of the economy will also interact with other broader issues such as trade, sanctions and budget reform post-COVID. Thanks, Viva.
Thank you so much. And I'm going to have one question now because we only have a few minutes left. I'm going to address one question. I ask each of you to give 90 seconds to it, and I please ask you to keep to that time because we're on a schedule here. So one of the topics that clearly has come up is that both the taxation of income and consumption would have caused and will cause a drag on the economy. And so therefore I'm asking you each, is there a role for a wealth tax of some kind? And I have an agenda here because I was the drafts person or the policy person behind a mark-to-market regime in the US, which clearly didn't go through. But mark-to-market means taking assets of some kind or other and valuing them every year and requiring taxpayers to pay tax on the change in value, including if they decline in value to get some kind of either a benefit or a credit or a refund for that. So a wealth tax is, of course, very controversial. A poll tax, as Tom Barthold mentioned, resulted in riots. But it seems that there is an issue of embedded wealth in the country and the inequality that causes. So if you could, each of you in a very brief period, say whether you support some kind of wealth tax and whether you think there's any kind of political support that could ever be gotten for it. And if not, and I suppose if not, what the alternatives are to improve improve equality. Now, I understand I'm going to give you 90 seconds. So maybe you could just briefly speak to the issue. And I'm going to start, if you don't mind, with Danielle. Can can you speak first to this topic? And then I'm going to ask, so we're going to go as we did through the other panelists. We'd start with Danielle, then Sonia. As we went through the speeches till now, I'd like you to answer the questions. Please keep to 90 seconds.
Sure, absolutely. Look, so I think, it is attractive in principle. I imagine it is extremely complex in practice. And Viva, you obviously have some experience with this, but I imagine a world of trying to revalue assets across the economy year on year is very challenging. The other challenge you're clearly going to hit across is the asset-rich cash-poor. So I imagine particularly reevaluating people's houses every year, there are going to be people that will struggle to pay that. So you will absolutely, design issues are going to loom large in that sort of structure. So it's a very radical change. One, given that we can't even remove refundable franking credits, I have little confidence that there would be any scope for something that radical. There are hybrids that go to wealth that we could look at. Inheritance tax, I almost don't want to say it, but it will be an increasing challenge for inequality in coming decades. There is a huge and growing amount of wealth in the hands of older Australians. In 20 or 30 years, that is going to be passed down. We know that you are more likely to receive an inheritance if you are already well off and increasingly older as well. So we will see a significant increase in wealth equality in decades to come because of those inheritances. We could have that conversation again. It is also politically challenging, but I do wonder if you could package it up with a series of income tax cuts that allows you to show that actually most younger people would be better off under that world, whether you could perhaps sell that. So I think anything around wealth is politically hard. I do think maybe something less radical is possible, but it's always challenging, and I think it depends how you package it up.
Thank you. Sonia, you want to speak 90 seconds?
I agree with Danielle. The maturity of the conversation is not there yet. Like, we are still at a point where we're calling millennials that they lack resilience. So I can't even imagine a world where a death tax, that we could have a mature conversation about that. And that's for two reasons. One, I think, is that there is no trust in government. So grandparents think, I know what's best for my grandchildren or my children. I want to be in control of the inheritance that gets passed on to them. The second, which is that we haven't got frames of thinking that build that broad-based consensus. And that brings me back to intergenerational fairness, because when we are asking the question, we change the question that we're asking in support of reform. Instead of it being, what are you willing to give up for a hypothetical poor person that you have nothing in common with? The question becomes, when we talk about intergenerational fairness, what is the legacy you're leaving your children? So if we can move the conversation to framing it in that way, maybe we can have a more mature conversation about taxing assets.
Look, I've got very, very clear views on this. I'm more optimistic, actually, about the general principle of getting it right to tax wealth appropriately. And I think, Liam, when you highlight that actually it's wealth inequality that strikes at the heart of people's fear. You lose your job, what have you got behind you? And if you're a young person, you've got nothing and you're getting nothing behind you. There's something deeply corrosive to that. And this is where the huge inequalities are being presented in the Australian context, because overall we're still a very wealthy country. I think we've dropped down to maybe third now, global ranking in terms of wealth. Okay, so overall big picture, extremely important we get the tax base right in that front. We're strongly opposed to any touching of the GST. Do not do it. Consumer confidence is everything. It is deeply regressive. It's a bereft debate. Please, let's not go there. Let's look at and do something serious about the land tax base. I think, Danielle, you're kind of thinking around that is a version of a wealth-based tax, yeah? That we craft that carefully. The New South Wales government has talked about it. We've got a number of states who are going there. We could genuinely build some broad consensus from the business community, the union movement, and community sector and economists to have the right narrative about why we're going to do that, and absolutely put on the table that to do that we would then be investing big in job creating, great jobs for younger people around, building more housing, good housing for the country. The second area I touched on is superannuation. That's wealth. That's big. You've got it. You've got a lot of it, and you're doing extremely well out of the tax system. So, as I touched on the, taxation of earnings. Do those two things rather than getting into. I don't think it's. Let's not talk about taxing wealth as radical, Danielle. I think I completely disagree with that. I know what you're getting at.
It's broad-based across the board wealth tax. I'm with you.
Ladies, we only have a few more minutes. Let me jump to Liam and see if he has to say something on this.
Yeah, well, look, I spoke at length about obviously wealth inequality, and so I don't want to really cover off on that, but I do want to agree with both Cassandra and others around land tax. That is clearly something where we could build some consensus around. We would say we'd need to be very careful about how we provide, in particular, low-income earners some concessions around that. It should be based on their incomes and not necessarily on land value, but definitely that is an opportunity. Agree entirely about superannuation. That is definitely a stream that should have significantly more tax treatment, in particular in the retirement phase around incomes that clearly needs some addressing. But I do want to pick up on a couple of the other points, and I'll say in relation to inheritance tax, I mean, my personal view is that this is the most unmeritorious and inequitable way in which we transfer wealth in society. It is just completely bonkers that we do not have something looking at this. I'm very conscious in saying that those are very supercharged political debates that get projected onto others that are much more political players in terms of how that interacts in elections. But I think the one thing I'd sort of say that I didn't think did get enough attention is around abolishing the capital gains tax discounts and really taxing capital gains the same way we tax other sources of income is a really critical thing that we have to talk about going forward, because as others have said, we cannot place as much burden on working people through income as we are at the moment if we're going to ensure that we're going to get a much more equitable tax system.
Thank you. And Ellen, any comments on that?
Thanks, Viva. Lucky last. I think a wealth tax is an interesting question, but I think it's probably quite a narrow question. I prefer the approach that the TTPI is taking in looking at the taxation of savings overall and sort of systemic differences and how that might be distorting the system. And I think moving towards a sort of more simple and fair taxation savings regime would get you a lot of the way there in terms of that focus on wealth tax.
So thank you all very much for really stimulating discussion. I was unmoved on my chair just listening to you all. I wanted to end with an anecdote, which is in our tradition, marriage matches are made in heaven. When you matchmake you, they tell you, we found the one who's intended for you, and it was decided for you 40 days before you were conceived. And so the tradition also says the best matches remain in heaven. So they began in heaven and the best matches remain there. So I say the same thing about tax reform. The best tax reform ideas remain in heaven and the only second best ones come down to earth and we get to work with them. So thank you very much for presenting best and second best ideas, and I really hope we get to have more discussions about this in the future. So we are now going to have a break and there will be a blank screen, so it doesn't mean that the conference has ended. It just means you get to go and have a coffee or chat with your second best a marriage match or whoever it is you get to talk to in the middle, and we will see you in about 15 minutes. So there will be a blank screen or a non-person screen, and then we will start again in 15 minutes. Thank you very much for everyone participating.
But anyway, Lawrence, up to you. I think you need.
Good morning, and welcome back to our second session on corporate taxation, problems and options. My name is Kristen Sobek, and I'm a Senior Research Officer at the Tax and Transfer Policy Institute. It is my pleasure to chair such a distinguished panel with 4 authoritative experts on corporate income taxation. Dr. Ken Henry has decades of experience working on Australian tax reform. He was Secretary to the Treasury from 2001 to 2011 and chaired the Australia's Future Tax System Review, also known as the Henry Tax Review. Dr. Craig Emerson has published significant research on rent taxation, worked as Senior Economic Advisor under the Hawke government, was a leading minister across multiple portfolios, and has also worked as a senior public servant. Dr. Anne Kais Kumar is a senior lecturer at the University of New South Wales. She is an expert in the areas of international and Australian tax law and corporate strategy. And finally, Adam McKissack is the Business Council of Australia's chief economist. In addition to leading economic policy and analysis in the BCA, he previously worked as a senior executive in the Australian Treasury on tax, among other areas. I prepared one question for each of the panelists, who will have a maximum of 7 minutes to respond to their questions. They've promised that they'll keep to the time, and that should leave us with about 30 minutes of questions at the end. Please feel free to send your questions through as we go along, and I will refer those questions to the panelists at the end of each of the 4 speakers. With that, we'll start off with Ken Henry. About 10 years ago, the Henry Tax Review recommended a series of reforms to corporate taxation, a lower corporate income tax rate, consideration for business expenditure tax, simplifying and streamlining capital allowance arrangements, among others. Are the reforms proposed then still relevant today? What would you add, change, and or prioritize in light of the passage of time in general, but also because of the coronavirus? Over to Ken.
Well, thank you. And it's a pleasure to be with you this morning. I come to you from the land of the Biripi people on the mid-north coast of New South Wales, a lovely part of the country. Reflecting on this morning's summit, one thing that has occurred to me, and I don't know that it's already been mentioned, is that, of course, 2020 is a very auspicious year for tax reform, or at least it was meant to be, because the tax review that I had the privilege of leading, the Rudd government's tax review, was, of course, commissioned pursuant to Kevin Rudd's 2020 summit that he held in 2008. And the proposal to have a broad sweeping, essentially once in a generation tax reform, that was a proposal that came out of the business working group at Kevin Rudd's 2020 summit. So it was all meant to be over by now. We were meant to have done all of this, so much for grand ambition. When we were working on the tax review more than a decade ago, it was obvious to us that the tax system was placing, too much reliance upon very unreliable tax bases. These tax bases that were suffering from erosion, and tax bases characterised by high elasticities of demand and supply. We considered then that Australian governments, Commonwealth and state, needed to find a way of shifting to more reliable tax bases. Now, not coincidentally, those more reliable tax bases, consumption, land and other natural resources, generally involve smaller deadweight losses or excess burdens than personal and company income tax, which the Australian tax system continues to rely, in fact, increasingly heavily. It was also evident to us a decade ago that Australia had to find a way of positioning itself as a more attractive destination for globally mobile equity capital. This country benefits from importing equity capital from abroad, yet our particular company tax system, incorporating full dividend imputation, acts as a tariff on imports of equity capital. That's what it is. The protective effect of this particular tariff benefits resident shareholders, of course, but it damages economic activity in aggregate and workers in particular. The size of that damage increases with the absolute value of the elasticity of investment with respect to its user cost of capital, and also increases as the elasticity of supply of foreign equity increases. Now, in a relatively small open economy like Australia, the latter can safely be assumed to be very large, approaching infinity, at least in most sectors, implying that much of the company tax burden is borne by Australian workers in the form of lower paying jobs. So cutting the company tax rate seemed to us among the most obvious reforms for us to be recommending. But my view at the time was that it was not the most important tax reform. Obvious, yes, but not the most important. Top position in my mind went to the mess of arrangements applying to natural resource extraction. Indeed, it was my view at the time that the case for cutting the company tax rate in the absence of reforming natural resource taxation was weak. Yesterday, by coincidence, I came across a list that I jotted down a decade ago under this heading, Australian Angst. And here's the list. 1, two-speed economy. Remember some of this stuff. 2, land use tensions. 3, shortages of skilled labour. 4, infrastructure deficits. 5, sensitivities over foreign investment. 6, delays, complexities and cost associated with project approvals. 7, taxation. Everything on this list was attributable to the resources boom, which at the time had been underway for less than 5 years. Well, it's now been underway for 17. In September 2008, just before the collapse of Lehman Brothers signalled the onset of the global financial crisis, the Reserve Bank's index of commodity prices was 3.5 times its average level of the 1990s. Terms of trade were 80% above their average level of the 1990s. Both of these things are a little lower today, but only a little lower. Back in September 2008, 5 years into the resources boom, the real value of the exchange rate had appreciated by 1/3 above its 1990s level. So if you were in mining, you were doing very well, notwithstanding the loss of international competitiveness implied by that figure. But just about every other trade-exposed industry was stuffed. While mining investment was accelerating pre-GFC, non-mining investment had already stalled. Mining investment has come off its post-GFC heights, while non-mining investment remains stalled. In aggregate, there's been insufficient investment even to keep pace with employment growth. The Australian economy has therefore experienced capital shallowing for some years now. Capital shallowing implies weak, even negative productivity growth and weak real wages growth. Natural resources make up more than a half, in some years as much as 2/3 of Australia's exports. Mining doesn't employ a lot of people, but it has a huge impact on just about every aspect of economic performance, including various state budgets, of course. One might think that a country with our natural endowments would understand the critical importance of getting right the taxation arrangements for extractive industries. Not so. So where are we today? Well, I'll make just 3 observations, and these are my concluding observations. First, and this is ironic, in the past decade, our political leaders in Canberra have figured out that having defeated Kevin Rudd's resources super profits tax, they should not now cut the company tax rate for large businesses, because if they did so, that would provide the miners with an unjustifiable tax windfall. So my first point is, until we fix the taxation of natural resources, we will not have a cut in Australia's company tax rate, at least for large businesses. My second point is this. A decade ago, our unique reform starting point of full dividend imputation made it difficult for us to consider more adventurous options, like an ACE. That remains the case in my view. Clearly, domestic pooled funds, like our superannuation funds, can no longer be considered to warrant the infant industry protectionism implicit in current taxation arrangements. But until that point is generally accepted, and it's not, we might be stuck with what we've got. And finally, the resources super profits tax was killed off because of some brutal politics and a deficit of economic literacy. Most of the commentary on the tax, frankly, was simply stupid. Now, we might not be able to do much about the state of politics in this country, although we should accept Tom Barthold's view that national leadership is absolutely essential. As to economic literacy, we must believe that we can do something. And I think that will mean accepting John Hewson's challenge when he opened the summit this morning to develop a new reform narrative, or as Tom Barthold puts it, to identify the goal in language that resonates. Thank you.
Thank you, Ken, for those insightful comments. I'll pass to our next speaker, Craig Emerson. Turning to reform of the corporate income tax base. Craig, you've consistently been a strong proponent of the cash flow tax. Why is reform of the corporate income tax base, as opposed to just the rate, so important, particularly right now? And Ken just touched a bit on that. And secondly, why do you think that a national cash flow tax is a more appropriate alternative than other rent taxes, such as an allowance for corporate equity? Over to you.
Well, thanks for welcoming me. And I'm on Ngunnawal country, Ken, in the People's Republic of Canberra. So far, pretty much COVID-free, and we're going to try to keep it that way. But I'd like to take up Ken's introductory comments about 2020 vision and make a claim that's unprovable. And that is that Kevin Rudd got his idea from me. This is a report of a series that I convened in Queensland in the mid-1990s called 2020 Vision, Australia's Future, the next 25 years. And we had Bob Hawke speak, Wayne Goss, Rick Farley, Malcolm Turnbull came up, Michael Wooldridge, Deputy Leader of the Liberal Party, Peter Garrett, and an array of Dale Spender, an array of others. And I have to report, sadly, that none of the predictions or even many of the hopes for 2020 back in the mid-90s has proven to have developed. And sadly, it's a pretty somber year for the reasons that we all know. But thanks for having me talk about taxation of company income. As to your first question, I found in the period under the coalition government talking only about the rate to be really curious, because if you're trying to develop a project, you're going to look at the expected net present value of that project before and after tax. And you could have an absolutely prohibitive base, like a brutal base, and a lower rate, or you could have, a high rate with no base to it. And it just seemed weird to me that corporate executives would scratch their heads and say, look, can you have a look around the world for the lowest rate of company tax and we'll invest there, without having any consideration of the base of the tax. And the base, obviously the rate's important, but I think the base is fundamentally important because it does affect the expected net present value or the expected profitability of any particular enterprise. I think I agree with Ken. We're going to find out that really what we should not be doing is taxing the normal returns from corporate activity. And one way of exemplifying that probably is restaurants. Do we really want to tax restaurants hard when they compete hard, and even the best restaurants that get an advantage, others tend to learn what advantage that is and then compete away, those temporary excess returns or higher returns, if you like. So in competitive markets, we really shouldn't be trying to make projects or activities that in the absence of tax would have been viable, unviable. We really don't want a tax system that knocks projects out and businesses that just make those normal competitive returns to investment. Now, what is that competitive return? Well, I suppose it would depend on the industry, but it's, a few percentage points, right? It's not 20% returns or anything like that. And you even see some of the most famous restaurants going broke. So I think that's not a bad example. However, we've observed over time, increasingly and very much illustrated by Ken's presentation, the existence and persistence and probably the increased prevalence of rents, various forms of rents, Those rents in Australia are obviously resource rents, as described by Ken. There's also land rents. You know, if you want to have a house on Sydney Harbour, you've got an advantage compared with one, you know, in the middle of a crowded city somewhere with no view. There are monopoly rents and oligopoly rents, and I won't go through all of the forms of rents, but Robert Solow actually said in a private correspondence recently, he kind of missed out. There was capital labour, and he realised that there's another big return, you know, to investors, and that's rents. So the smart thing would be to concentrate taxation on rents and not hit that normal competitive return. Now, cash flow tax does that, and the cash flow tax was actually proposed way back in 1948 by a fellow named E. Carey Brown. And it's quite simple. Think of it this way. It is like the government being a private equity partner in any business, the true cash flow tax, because negative cash flows, which would be investment costs, wages and so on, they're immediately expensable. That includes all capital equipment, immediately written off, instant asset write-off in the current terminology, right? So that's kind of good. But any positive cash flows are taxable in the year in which they occur. So it's therefore a two-sided tax. If you have negative cash flows, what happens is that the Commonwealth, the tax office actually steps in and compensates for the size of that negative cash flow multiplied by the tax rate. So let's think of an investment. You're investing $100 million. Under a cash flow tax, if the tax rate is 30%, then the pure cash flow tax involves the government contributing $100 million of tax, like tax refund, if you like, to that. But if then the next year your net cash flow, your cash flow, positive cash flows minus the negative cash flows, say 300 million, then the Commonwealth picks up 30% of that, which is 90 million. So each year, you just tax the actual cash flows at the tax rate or refund the negative cash flows at the tax rate. That's the pure Brown tax, the pure cash flow tax. Now, that is actually effective at taxing rents, but it does not tax those normal competitive returns to investment. That's why I like it. It was the subject of my PhD thesis, but we came up with a variation of it because Ross Garno is my thesis supervisor and he told me to, and that is the resource rent tax. And that I had the honour really of when I finished my PhD of working for Finance Minister, Resources Minister, then Finance Minister Peter Walsh, and got to implement the PhD in the form of the petroleum resource rent tax. Now, it's not a pure cash flow tax because it's not two-sided. You get to carry forward those negative net cash flows at an interest rate, and under the resource rent tax, it's a risk-adjusted interest rate. So it isn't strictly neutral, but the Brown tax or the cash flow tax is strictly neutral. So why would I then say, well, let's not do the pure tax. Let's not do something close to the pure tax, but pick up another idea, which is this allowance for corporate equity. I think when we talked earlier, there was some suggestion that this might not be creditable for international tax purposes, but I'd ask in reply that we know the petroleum resource rent tax is creditable. We know that in Papua New Guinea, the additional profits tax is creditable. So I don't see any particular reason why this wouldn't be creditable. And it is very, very simple. I don't want to take up all the time, but I'll explain how you could do quite small departures from the cash flow tax. And you know what you get? Ken Henry's resource super profits tax. What I'm advocating is pretty much exactly Ken Henry's resource super profits tax for corporate income in Australia.
Thank you, Craig, very much for those helpful comments. I'm going to pass the floor to Ann Kais Kumar, moving from a cash flow tax to other reforms of the tax base. And in your recent book, Taxing Multinationals, Preventing Tax Base Erosion Through the Reform of Corporate Cross-Border Intercompany Deductions, you conclude that the combination of an allowance for corporate equity and a comprehensive business income tax, in combination with an extended thin capitalization rule. This would significantly limit the scope for base erosion and profit shifting by multinationals in Australia. First, how does this ACE-CBIT combination improve on an allowance for corporate equity alone? And secondly, do you have any thoughts on how this combination might fare in comparison to something like a cash flow tax? Over to you.
Thank you. Thank you so much, Kristen. And can I just say what a pleasure it is to be here on this panel with you all today. Following Ken and Craig's lead, I am here from Coogee, which I understand is both Bidjigal and Gadigal land that was used in quite a happy medium sort of way. And so to respond to your question, Kristen, it's the happy medium that I'm looking for. And that's why I propose an ACE-CBIT, because it deals with the legitimate policymaker concern that an ACE on its own would have a revenue issue associated with it. And the underlying basis for my research and my book, which is part of the end product of my PhD, there seems to be a common thread, Craig, is that what we should be aiming for is reform that is theoretically desirable but also practically feasible. And so what an ACE-CBIT does is it reduces the revenue cost while at the same time reducing the tax-induced distortions in the existing system. And so there are, and I definitely acknowledge, like you say, there are a range of rich fundamental reform options that currently exist in the economic literature. And full disclosure, my PhD, my supervisors, Emeritus Professor Neil Warren, who's an economist, and Professor John Taylor, who's a lawyer, greatly informed the foundational basis and assumptions in my thesis. And at its absolute nucleus is the notion that we should be striving for economic efficiency. So full disclosure there. Often the fundamental reform literature will look at the debt equity bias, and within that, while many fundamental reforms target the debt equity bias in different ways and ultimately under the umbrella of corporate tax-induced distortions, the ACE and its variants are most commonly experimented with in practice. And so as a source-based economic rent tax, providing a deduction for equity, or if you do an ACE-CBIT, a partial deduction for equity and a partial deduction for debt, this is relatively complementary to the existing infrastructure in the tax system. And the reforms have been experimented with in jurisdictions like Austria, Belgium, Brazil, Croatia, Cyprus, Italy, Malta, Poland, Portugal, Turkey, often with the modification, so they're all variants, and often with the modification that they use new equity as the base rather than the full sum of equity. This is appealing for a range of stakeholders, from multinationals to SMEs, who will often get an increased ACE rate as an added sweetener, which also deals with the issue around how corporate tax cuts may not necessarily assist SMEs as greatly as what might be assumed, and also government too, because of the cushion from having a partial ACE as opposed to a full ACE from a revenue perspective. Though I will also say it's not perfect and it's not a silver bullet. There are socio-political, legal and policy challenges that jurisdictions that have implemented an ACE have experienced, and I'm more than happy to dive into those. But ultimately, the ACE, going back to your initial question, Kristen, is a cousin of a cash flow tax, and it has a similar grounding in the idea that there should be a notional return, often benchmarked by a 10-year government bond rate. That might present another challenge in the existing environment too. So there's a lot to unpack. I'm not going to monopolise any further, but I'd love to have a more detailed discussion with you all.
Thank you, Anne, for your very helpful comments. Turning to Adam, we're going to shift away from fundamental tax rate changes and focus a bit more on economic stimulus with my question to Adam. And Ellen actually touched a bit on the question that I had prepared for Adam in the previous session. The BCA is advocating for the introduction of a 20% investment allowance to spur investment. Could you please describe a bit more in detail what this looks like, particularly since, depending on their design, these policies can disproportionately impact or benefit some industries, notably mining, more than others? What are the other, and in addition to that, what are the other policy solutions that the BCA envisages would help business and stimulate investment in the short and medium run, particularly in light of the pandemic?
Okay, thank you, Kristen, and it's a pleasure to be here. I'm also hailing from Ngunnawal country here in Canberra, where the fog is just starting to lift, which is very nice. Maybe just setting up the problem a bit first. And as Ken alluded to, we've had weak business investment for a while now, sort of pre-crisis. We're looking at pretty lackluster business investment. That was feeding into some low productivity performance and low real wages. So as Ken nicely put it, low investment, badly paid jobs, right? Now we're in a crisis, and if you looked at the forecast that came from Treasury a couple of weeks ago, that shows business investment collapsing. So the levels they're forecasting would be levels we haven't seen since the early 90s recession. And it's even worse if you look at the non-mining sector. So for non-investment, Treasury had investment falling by about 30% over the forecast period. We think that would probably take non-mining investment to the lowest levels we've ever seen, certainly in the sort of history we can look at. I guess sort of a third sort of general point I make is that, you know, capital is flowing out of Australia. So for the first time since the early 1970s, Australia is running a sustained capital account deficit. So Australia is finding more investment opportunities offshore than offshore investors are finding in Australia. And that's very unusual for Australia. It's very unusual for a resource-rich country like Australia. You can even see it if you just look at the US, our largest investment partner. In 2019, after US FDI averaged about $15 billion in the previous decade, that investment fell to about $600 million. And that followed the US tax changes. So coincidence or not, probably not. So there's a lot of things to kind of be worried about in terms of what's happening in business investment, particularly if, you know, we need a private sector-led recovery. You need investment to be stronger. Now, can we pin it all on the tax system? No, we can't pin it all on the tax system. I mean, answers don't all lie in the tax system. Obviously, you need to look at monetary policy has obviously been a traditional way we spur investment. That is basically maxed out to its, you know, the greatest extent it can go. And probably those low rates are really sort of being offset by perceptions of high risk premium. I think consumer demand is really important in the short term. So any sort of allowance you think about needs to come in the context of, you know, continued fiscal support, and that needs to come through the tax and transfer system. And then there's areas like energy policy where, you know, greater policy certainty would unlock what we think is quite a substantial amount of investment that sort of could be ready to given the right sort of policy goalposts. So tax isn't the only answer, but we think it's an important part of the puzzle. So what we're proposing on the investment allowance is it's similar to what we did in the GFC. So what we're proposing is a bonus deduction of 20% up front. That's in addition to normal depreciation. We would apply it to all investments. So I think the GFC version was mainly sort of focused on plant and equipment. We'd want to pick up things like intangibles, intellectual property, computer software, so sort of picking up, you know, businesses who want to sort of have that digital transformation, sort of picking up sort of some of the trends we've seen through the crisis. There has actually been some work in the Australian context in how successful the investment allowance is. The RBA had a research discussion paper released in 2018, and that sort of did some modelling of the GFC investment allowance, and it came to three conclusions. One is it did boost investment. Secondly, it created new investment. It wasn't just to bring forward some temporary allowance. And thirdly, it did raise GDP. So I guess on that analysis, at least, you know, it has been shown to work in the Australian context. And we know just from talking to the companies in our membership, there are projects that sort of haven't made the cut on capital allocations. If you created an incentive, could be brought into the system. And I think really at the moment, businesses have a choice to make between waiting and seeing and sort of just wait for the uncertainty to fade, search or invest now. So the idea of investment allowance is lock the balance sheets of corporates when you need to. You did sort of raise the question about it's sort of, disproportionately benefiting capital investors. I had that session this morning. And certainly, look, if you had an investment that was used by miners, it would be used in agriculture and by utility investors. But really, I think a lot depends on the design. So if you have a very broad investment allowance, I think you're much more likely to pick up investment right in the economy, not just the sort of big nuts and bolts investments. We also think the allowance really has to be for companies of all sizes. 80% of investment is actually comes from larger companies, companies over 250 million. And it's really those larger projects that create the multiplier effects through the economy. So you really got to have a allowance that sort of applies to everybody. I know a lot of investment incentives tend to be targeted at the SME end of the market, and they have their place. But if you really want to unlock those big projects, it's got to apply to all companies and be as broad as possible. So yes, I think BCA sees an investment allowance as crucial right now. It's it can do a lot of good. It's something you can deliver in the short term. Which certainly, I think the ideas around cash flow tax and the ACE are really worth looking at, and I think they sort of have a lot of appeal in terms of encouraging greater investment in the sort of medium term. But I think they'll take a little bit longer to actually implement and sort of get going. So I think the investment allowance can be done in the short term. We can do it quickly when we most need investment. I think I've hit my 7 minutes, Kristen, so I'll throw it back to you. Thank you.
Great, thank you, Adam, and thanks to all the panelists for their very insightful and helpful comments on corporate income tax reform in Australia. With that, we have a long session, an additional 20 minutes for questions, so please continue to send through your questions and we'll review them. In the interim, I can start us off with, the question explosion. All right, please keep sending them through. We'll start off with a question for Craig. Craig, do we really want to implement a cash flow tax that no one else has experimented with at a national level? I promise I didn't write that question. I actually share the question. It seems very risky compared to an ACE, which other countries have implemented, tried and tested, and
well, it's actually less risky than an ACE because it does fully compensate for negative net cash flows and taxes positive net cash flows. An ACE, particularly if it says we're going to make an allowance for corporate equity at the bond rate. Imagine our restaurateur getting up in the morning and going to work and say, ho, 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 I'm going off to get the corporate bond rate. How exciting. This actually fully compensates for negative net cash flows. And I think to address Adam's concern, and really what's implicit in this question is, could you just do this in one big bang? Possibly, but I think things are so urgent because of the massive drop in private investment that both Ken and Adam have talked about, 19.5% next year, non-mining private investment. I mean, that's catastrophic. You could do something in stages. So early on, I wouldn't support, Adam, an investment allowance which says the total amount of write-off exceeds 100%, right? And if that's what's being proposed, I think that itself is distortionary. But you could go pretty much to instant asset write-off, immediate expensing, which would be more powerful than a 20% investment allowance. The Labor Party took an investment allowance to the last election, the Australian Investment Guarantee, but what it did is picked up the later years and put that bonus up front, but the total write-off was still 100%. Well, what I'm suggesting is 100% write-off for the lot, right? Not only for the small businesses that are now, as part of the stimulus, the government has increased instant asset write-off to businesses with a turnover of up to 500 million. So we're getting up from the really small businesses, but I'd just take it all the way through. Now, people might say, gee, that's expensive, but wow, you know, if we're going to get productivity going, if we're going to have actual reform, we need that investment. And I think it is perfectly defensible to start with something like immediate expensing, but make sure that that is an instalment on the road to a fully reformed corporate tax system. And that's why I'd say a cash flow tax be it. But look, if someone said, Craig, you're wrong, it's got to be an ACE or something like that, let's think about that. But I think cash flow taxation is so simple, so clear, that we should say that's the destination, but anything we do on the way must be a contributor to that, not a departure from it.
Thank you, Craig. We have another question on franking credits, which doesn't have a specific, it's not directed to one specific panelist, so feel free to jump in, whoever would like to take it. If we want to reduce corporate tax rates, should we do this in conjunction with abolishing or reducing franking credits, or should we retain these credits? Are they important?
Well, I can probably
Go, Ken.
I can probably take this. I mean, look, if you cut the company tax rate, obviously franking credits fall, because franking credits are just a refund of the company tax to domestic resident shareholders, but only domestic resident shareholders, of course. Now, so it's just a natural consequence of cutting the company tax rate. But there's another issue here which I made note of in my introductory remarks, which is that if you start with a system of full dividend imputation, which provides this amazing tax outcome for resident shareholders, but only resident shareholders, and you then want to replace that with a different model of corporate taxation that provides some level of corporate protection for equity, that is, preventing the double taxation of equity, then it's quite challenging as a starting point. You're starting from a position where there's effective double taxation of foreign equity and there's no double taxation of domestic equity, courtesy of the imputation system. And all of the proposals, including cash flow tax, and I support Craig's views here, by the way, but including cash flow tax, levels the playing field as between domestic shareholders, that is resident shareholders, and foreign shareholders. And in that, I think, and I think the last election demonstrated how difficult it is to try to take even a small step in that direction. In the last election, one of the parties, the Labor Party, had a proposal, obviously, to just limit refund of excess franking credits. Imagine if you said we're going to deny all franking credits and then we're going to replace it with some notional allowance for, a normal rate of return on the equity you got invested in the company. Well, good luck.
And while we're in the realms of the real world, I really do not see any prospect of cutting the company tax rate, because you would be cutting it for banks that earn good profits. You would be cutting it for resource companies that are earning very good profits because of the iron ore price. And you're giving a windfall on all those investments that were made at the 30-cent rate. And, describing that as a reform, I think, is very challenging when you can actually reform the base and achieve the sorts of, benefits for foreign investment without having to face those difficulties.
Thank you both. I think, did we lose Ken? In the interim, I can ask another question, which perhaps piggybacks on the question which was just asked, was about your response to the corporate income tax rate, Craig, just then, is that one of the rationales for cutting the corporate income tax rate is precisely to attract investment. But at the moment, we have a current account surplus, so why do we need to attract even more? Isn't this one of the arguments?
I'm happy to address that. Why do we have a capital account deficit? That is, why do we have a current account surplus? Perhaps that has something to do with the way we tax corporate income, right? And the point is that think of domestic resident shareholders. And what's happened over the last 10 years, in fact, of course, goes back a lot longer than that, is that superannuation funds have become an increasingly important part of Australian capital markets. And for superannuation funds, investing in domestic equities and investing in foreign equities, these are substitute asset classes. They're close substitutes, but they're not perfect substitutes. When other countries around the world cut their company tax rates, Australian superannuation funds are going to shift a higher proportion of their portfolios to foreign jurisdictions, obviously. And that's exactly what they've been doing. It's just a classic substitution from, it's Econ 101, from an investment in an Australian asset class where the tax regime doesn't change to an investment in an alternative asset class which happens to be offshore, in which the return is improved because of cuts in company tax rates offshore. And that's what domestic superannuation funds have been doing. But at the same time, of course, the cost of capital to Australian corporates has gone up. And the reason the cost of capital to Australian corporates has gone up is because the opportunity cost for foreign investors, that is the cost that the return that needs to be covered given the opportunities that they have elsewhere around the world, that opportunity cost has gone up and there's been no change in the company tax rate. And so Australia, sitting on its hands with the company tax rate, has seen a larger proportion of superannuation fund portfolios being invested offshore, an increase in the domestic cost of capital to Australian corporates, lower investment. Now, of course, one of the consequences of that is that the gap between national investment and national saving has narrowed. That is, current account deficit has been wiped out. This is not something we should be celebrating. It's happened because we've got weak investment, and the company tax rate has something to do with that weak investment.
And presumably we want the investment not just because we've got lots of, capital equipment lying around, but because it's modern capital equipment that embodies the latest technologies, which improves labour productivity, which does everything that we want to do. The intergenerational reports estimate that productivity growth has been responsible for more than 80% of our increases in national income per person. So we desperately need productivity growth, and Ken talked about capital shallowing, which the Productivity Commission has referred to. We've had a period recently of negative productivity growth. Like, it's just gone like that over the last few years, and we can't just sit around saying that doesn't matter. But also, to pick up Adam's point, the investment can't just be in physical assets. It's got to be in intangible assets as well, because they definitely embody the latest technology. So it's all about productivity growth.
Just on this point, I mean, we've got to remember every country in the world is going to be facing its worst recession in decades, right? So everyone is going to be chasing global capital. And what are other countries going to do? Are they going to be raising their tax rates? I don't think so. So, we may even get a bit of a first mover advantage just given where Australia is in terms of getting on top of the crisis. And I know we've had some recent setbacks, but, we don't want to forget what everyone else is likely to do. They themselves try and dig themselves out of recession in the period ahead.
We have an additional question to all of the panelists. So perhaps we could start off with Ken and then do a round for whoever would like to respond. Should lower tax rates apply to small businesses? Ken, would you like to start us off again?
I presume the question is lower than what they are currently facing.
Yes.
But I think it's a mistake to have different rates of company income tax by size of business, and I don't see that it's necessary anyway. The reason why we have differential rates of tax in Australia is the reason that I referred to earlier and that Craig also referred to, which is that there's a view in Canberra, which is quite understandable, that the company tax, Australia's company tax, does a lot of the heavy lifting in taxing rents, particularly resource rents, but also rents that are associated with licences granted by government. That includes banking licences, but wouldn't be restricted to banking licences. We seem to have found a way politically of applying a special levy to banks. Now, it's not a particularly good tax, but we do seem to have found a way of doing that. We have a lot of trouble, it seems, in being sufficiently creative to find special taxes to tax other forms of economic rent. I reckon stick with a uniform rate of taxation across all corporate entities. But do what Craig's suggesting, at least move in that direction. Think about the base. And if there's if there's something about small business in particular that means that they need a special deduction, I must say I can't see it beyond what a cash flow tax would deliver. But if there is, do it by the base, not through the rate.
Adam, would you like to respond, or Craig or Anne? If you agree or disagree?
I think Ken said pretty well. I totally agree. It's a bizarre system of having these multiple tax rates in the company system. It does create some odd incentives to get that 50 million threshold. Do you expand your business or not? It's a funny incentive to create in the system, I would have thought. So I agree.
Anne, do you want to go? I'll just say something very briefly.
Thanks so much, Craig. I definitely agree with both Ken and Adam. The one piece I'd like to raise as well is that if there is a assumption in that question that small business should be given some sort of boost from a tax perspective because of the increasing financial challenges that that particular end of the market's facing, is of course the point that everyone will be thinking already is how many of them are already profitable. So then what will reducing the tax rate do for those ones that are not making a profit? What other ways can we encourage them to stay afloat and to invest in ways that will go to Craig's point, to boost our productivity? And so that would be my response.
Yeah. Well, if I just add a couple of things, there's probably a correlation between earning those normal competitive returns and nothing more with small business. There'll be startups and so on, and they could end up being Microsoft, so it's not perfect. But there's lots of coffee shops and restaurants and people who do fairly standard things and they don't earn rents. And in those circumstances, what small business already gets, which is instant asset write-off, immediate expensing, is pretty valuable. And to Adam's point, that Reserve Bank study actually showed that the strong respondents to the investment allowance of 2009 were small businesses that were cash constrained. They actually thought, if I do this, I won't have to pay tax next year. So they actually did invest in quite a lot. That it actually materially affected GDP. And as you said, Adam, the studies found that it didn't just really bring forward investment, it created new investment because their expected profits were improved. If you just do that through the try to do that through the tax rate, I can see a lot of businesses a bit above that threshold saying, I think we might just sort of break ourselves up into a whole bunch of small businesses. And so you get this, really ugly contrivance at the margins there of quite substantial businesses saying, all right, well, we're just going to get the lawyers in and the tax accountants and we'll make our one business into 20 small businesses and we get the small business tax rate. So let's not do that. Let's concentrate on the base.
Thank you all. One additional question. We'll start off with perhaps Craig, and then we can do another round robin. Why does the corporate income tax debate focus on the headline rate rather than the effective rate, which is much lower?
Hear, hear. That's what I've been saying. I mean, there's this obsession with the rate. And, I just cannot believe when we're trying to talk about multinational corporation investment in this country that, some of the smartest people in the world just sit around and say, get me a table of tax rates. Oh, geez, Uganda's low. Why don't we invest there? It's just, you've got to look at the entire tax regime, plus political stability, plus everything else. With all due respect to Uganda, it's probably going very well. But my point is, because I think we had, 3 or 4 years talking about the tax rate, it's become the thing. And then, governments have said, we can't get that up. Well, let's talk about the base, which is where I thought we probably should be talking in the first place, but that's history. We are all agreed here that the corporate tax system in Australia is not fit for purpose. And to pick up Adam's point, if we think that coming out of this crisis with a 19.5% drop in non-mining private capital investment, that we're confronting that, the rest of the world's confronting it too. And we will need a competitive corporate income tax system. And I say, let's not tax the normal returns to investment. Let's tax rents, which is far less distortionary, and go for the cash flow tax. But I accept it's a big bang. And so let's do things along the way that are not contradictory or departures from it, but take us towards it. And if someone can say the allowance for corporate equity works better in practice, happy to listen to that. But that's the direction I think we need to be taking.
Ken, would you also like to add anything or any of the other comments?
So I agree with everything that Craig has just said. But, I said earlier that one of our biggest challenges really is a paucity of economic literacy. And this is the problem, right? I mean, and this is just one illustration of it. It's quite a graphic illustration of it, that in public debate on tax reform, at least the company tax, people rarely go below the statutory rate. That's it. So we've got to acknowledge that there is an issue of economic literacy. Well, I'll give you another example, right? What about the debate about the rate of goods and services tax? Yeah, so when the goods and services tax was introduced, of course, the opponents of it said that it was highly regressive tax. Well, those people should have been in fact, over the history of the GST, the last 20 years, should have been celebrating the fact that the effective rate of GST or the average rate of GST has been declining through time because of base erosion. They haven't been. They haven't been celebrating that. And the reason they haven't is because, as far as they can tell, the rate hasn't changed, right? So, we have to understand that the public understanding of the things that we're talking about here is just miles apart from where we are. I mean, again, on the resources super profits tax, about a week after it was announced, I had a leading financial journalist call me and say, look, been talking to somebody at the Minerals Council who says, why on earth would you want to apply a 70% rate of tax to the cash earnings of mining companies? And I said, what are you talking about? And when I eventually figured out what the journalist was talking about, two things went through my head. There are two possibilities here. Either the person at the Minerals Council was completely stupid, moron basically, or that person at the Minerals Council thought that the journalist was a moron. Yeah. You can't get a 70% rate of tax. It's impossible to get a 70% rate of tax out of the resources super profits tax, even if you had an infinite rate of return on your project. Couldn't do it. But that's the level of economic literacy, or basic innumeracy, really.
Anne or Adam, would you like to contribute anything additional?
Thank you, Kristen. Just going back to, and that was quite a profound statement, Ken, going back to the point that Craig made in relation to if ACE can be shown to work in practice, often the reason for, and this might be a good litmus test for whether or not it does, is to look at why jurisdictions repeal an ACE. And often it's not because of it being ineffective, more so that it often meets political hurdles and is met with the challenge of, do we cut corporate headline rates or do we keep the ACE? And so that's one of the struggles that we're seeing in practice. It's not that it doesn't attain a lot of its objectives once implemented. It goes back to the point that Kristen was asking about before, that question from the audience member. I'll pause now just in the interest of time.
I would agree with what's being said. I wouldn't underestimate the sort of signalling effect of a cut in the headline rate, particularly right now. So, as I said, there's going to be a lot of competition. We've got different countries in our region sort of maybe looking less attractive as a destination than they were. So, an announcement of a 20% company rate could have a strong signalling effect. So I wouldn't totally discount that as a draw card.
Well, thank you very much for your very helpful comments. We've covered a lot of ground in the last hour. And so with only 3 minutes remaining, we decided that we'll pass the floor to our colleague Greg Smith for the next panel. Thank you very much to the panelists and to the audience for their excellent questions and responses.
Thanks very much. Enjoyed it a lot.
Thank you so much.
Thank you.
Just to let you know, we're on mute. So
Okay. Okay.
Greg, the floor is yours. Greg, we can hear you. The floor is yours.
Okay. That's good to hear that you can hear me. Well, thanks very much, Kristen. And hopefully we're all ready to go with the final main session of this exercise, which has a very narrowed down title. It's just called Revenue, Expenditure, the Federation and the Universe. So we are basically, we've had a federation for 120 years. We've had to rewrite the fiscal, tax and federation arrangements several times in that 120 years. The most recent time was in the year 2000, of course, with the new tax system and the introduction of the GST. We then had a big global financial crisis, and a few years after that we decided to have another rewrite of the federation, and that was in the 2014 period, but this time nothing happened. And now we're having another recession, and I guess the reason we're having this conversation is, well, do we try again what we failed to do 4 or 5 or 6 years ago? And so for our panel, we have people who have worked on that specifically. We'll be beginning with David Di Cavallo, who is the Chief Executive Officer of ACARA, and who is also someone who worked on the Federation White Paper in that 2014-15 attempt. We have Ross Lambie, who's the Chief Economist from the Australian Chamber of Commerce and Industry, who has worked at both Commonwealth and state level as well. We have David Thodey, who is the chair of the CSIRO and deputy chair of the COVID-19 Commission, but he's recently been chair of the New South Wales Financial Relations Review, which is perhaps the first attempt to bring these issues back. And finally, we have Professor Anne Twomey, who's the Professor of Constitutional Law at the University of Sydney, and who, of course, has written extensively on constitutional matters, including federation matters, federal powers. So we'll begin, as the previous session did, with each speaker talking for roughly 5 minutes, and then we'll see whether we have some questions to take it forward. So first of all, David, if you're ready.
Yes, thank you, Greg, and good morning, everybody. I'd like to begin by reflecting back in this year of 2020. It's interesting to look back at the discussions that took place in 2008 at Prime Minister Rudd's 2020 summit. In the economy stream, there was a substream on federalism, and it discussed the need to resolve the extent to which the Commonwealth should be able to direct or tie how the states and territories spend the funds available to them, and the need to ensure that the tax system works in a way that supports any new federal structure. Among other matters raised by the participants in the economy stream was the abolition of existing Commonwealth and state ministerial councils, because they were seen to be roadblocks and to delay important policy processes. Currently, people might be aware that following the replacement of COAG by the National Cabinet, these ministerial councils are currently being reviewed, and I would hope that that review is not seen as an opportunity to strengthen the position of the Commonwealth at the expense of the states and territories. It needs to strengthen the Federation, which means respecting the role of provincial governments. Perhaps somewhat presciently, the 2020 summit suggested that as an alternative to these various councils, all matters should go through COAG. But it also recommended a new independent Federation Commission, properly resourced by all levels of government, that should conduct a review of the roles, responsibilities and revenue sources for federal, state and territory and local governments in major areas of economic activity. Now, this task on the expenditure side was essentially the task given to me by Prime Minister Abbott in late 2013 when he established the reform of the Federation White Paper process. Our main focus was on health, education and housing. Importantly, while the Federation White Paper was to focus on the allocation of expenditure functions between the two levels of government, the Tax White Paper, which got underway at the same time and which is always seen as linked to the reform of the Federation process, that was going to look at the allocation of revenue-raising responsibilities as well as options for tax reform. The enormously ambitious program envisaged a kind of grand federal bargain between the Commonwealth and the states that would see a shift in revenue and expenditure responsibilities between both levels of government, and that would lead to a situation which Prime Minister Abbott described as each level of government being sovereign in its own sphere. Now, inevitably, it was the vertical fiscal imbalance that was recognised as the stumbling block. Of all the federations of the world, Australia is second only to Austria in the degree of the vertical fiscal imbalance, with states and territories raising just over half of all the revenue they need to fulfil their spending responsibilities and relying on the Commonwealth to supply the rest. Now, this exercises an enormous distorting influence over the politics of reform at both the tax and expenditure levels. Now, the reform of the Federation White Paper process was abandoned by Prime Minister Turnbull shortly after he took over from Minister Abbott. But this was not just a case of the new leader not wanting to champion the former leader's agenda. There were other reasons for the failure that had been long in train before that. For a start, while Mr Abbott may have been keen on clean lines of responsibility, it's by no means clear that all his cabinet, especially those ministers who may have been in line for a substantial narrowing of the avenues of influence and ambition, were on board with the program. Secondly, while there was strong support for the process from Premier Baird in New South Wales and Premier Weatherill in South Australia, the level of enthusiasm for the process was uneven around the COAG table. But without doubt, the biggest problem was the ever-shrinking tax reform agenda, which was supposed to accompany the Federation reforms. issues kept being taken off the table in response to political concerns. But in the end, it was a botched attempt to canvass the issue of income tax sharing at the COAG meeting of late March 2016 that ensured the effective death of both processes. Now, COVID means we'll be climbing a mountain range of public debt for decades. And getting to the other side will require coordination on both revenue and expenditure side at both levels of government. I think COVID also presents the National Cabinet with the opportunity to convene another national summit akin to a constitutional convention, if you like, bringing together politicians of all stripes, business and community leaders and academics, to consider how the allocation of our tax and spending responsibilities might need to change to ensure we're up for the long journey of economic and social recovery that's ahead of us. That will take courageous and skillful political and bureaucratic leadership, and I wish all our politicians and public servants all the best. But lest we underestimate the difficulty, I'd like to conclude with a quote from the much maligned Niccolo Machiavelli, and he says, "It must be remembered that there is nothing more doubtful of success nor more dangerous to manage than a new system. For the initiator has the enmity of all those who would profit by the preservation of the old institutions and merely lukewarm defenders in those who gain by the new ones." Thanks, Greg.
Thank you very much, David. That has certainly set us off on a very sober note. So thank you for that. Ross Lambie, what does the COVID future really mean for us?
Well, thank you, Greg. And look, I'd also like to thank the Tax and Transfer Policy Institute for the opportunity to present in the session. Look, improving Australia's tax system has to be a priority for reform if we're going to create the jobs, dynamism, resilience, competitiveness this economy will definitely need after COVID-19. The massive increase in spending on support measures by Commonwealth and state territory governments, along with the ongoing need for fiscal stimulus and a pronounced reduction in what was already shrinking revenue, means that we're facing a protracted process of budget repair. If we're to successfully limit the tax burden on current and future generations, it's essential that the underlying structural weaknesses in government's budget that will be laid bare by COVID-19 are addressed. I think it's fair to say that Australia's tax system is inherently flawed. I'm going to go as far as to say that it's replete with inequities of the way labour, land and capital are each taxed, and the array of expenditures in the form of exemptions, deductions, concessions and deferrals. Both the federal and state level governments are too reliant on unsustainable taxes and distortionary taxes that are either inherently inefficient or inefficient by design. There are also imbalances across the two tax systems and the roles and responsibilities of the Commonwealth and state and territory governments for raising revenue and spending on goods and services that gives rise to significant structural weaknesses in the budgets. We know that what the main issues are regarding the federal financial relations. The New South Wales review David's lead presents them very clearly. We've ended up with a set of arrangements between two tiers of government concerning responsibilities for raising revenues, incurring costs, and delivering functions that are unsustainable and produce inefficient and unfair outcomes. The Australian Chamber has been for at least, I think it's about nearly 3 decades, a strong advocate for comprehensive tax reform involving both tiers of government. If the Australian economy is to have business-led recovery out of COVID-19 that the Minister has called for, then tax reform must focus on how the system can improve the competitiveness and productivity of Australian businesses. Across the state chambers, surveys consistently show that state taxation issues are amongst the most important of all tax issues facing business. The National Cabinet, through the Council of Federal Financial Relations, has set itself the mission of resolving what the Commonwealth and state territory governments can do to reduce reliance and impact of inefficient taxes such as payroll tax that impedes businesses employing more staff and stamp duty that disincentivises people moving to new employment opportunities where the skills are really needed. State and territory governments rely heavily on these taxes for revenue and face the challenge of looming fiscal gaps in coming years as their expenditure grows faster than their revenues. An obvious place to start on tax reform that would stimulate business investment and improve jobs growth is for governments to agree on how to deal with the vexed issue of payroll tax. In their latest mid-year budget updates, state and territory governments were on track to collect somewhere around $27 billion from payroll tax, almost half the amount they share in GST revenue. And across the payroll tax rates from about 27% to 42% as a share of all self-raised taxes. A decade ago, the review into Australia's future tax system found payroll tax one of the nation's most inefficient taxes. Every dollar raised caused a welfare loss to the broader economy of around 40 cents. Currently, there's no clear alignment between the Commonwealth and the state territory governments on payroll in a shared problem. Although I've got to say, recent media, we have seen messages from the Prime Minister and the Treasurer and the New South Wales and Victorian governments that show each has very clear expectations of the other on this matter. If a reduction in the burden of payroll tax on business is to be achieved, it will need to be the Commonwealth and state territory governments taking a cooperative collaborative approach to reform options. State taxes are no longer solely state issues. If we're serious about getting a simpler and more efficient tax system, then the Commonwealth needs to play its part in helping the states move away from relying on inefficient forms of own source revenue, and the states will need to consider the national interest. The Council of Federal Financial Relations reached an agreement on the phased removal of payroll tax would be a really good start to demonstrate we are on the path to more comprehensive tax reform. And on that note, Greg, I think I'll leave it there.
Thank you very much for that, Ross. So we'll move straight on to another contribution now from David Thodey.
Thanks, Greg. And it's great to be here. And I really applaud both ANU and all the organisers for bringing us all together, because there's no question that we need reform. And as both Ross and David alluded to, we've just completed a review that was initiated by Dominic Perrottet nearly a year ago, by the way, was when he kicked off the review, to look at both federal financial relations but also tax reform. And we shared that report fortuitously on the 20th of July last month, which was 20 years from the introduction of the GST, which did not go unnoticed. I do want to put my comments into context as well, because I am on this National COVID Commission, and I do get to see all the challenges we're facing as a country at the moment. We're all aware of what's going on in Victoria at the moment, but getting people back into jobs and the focus of government at the moment on the economy and the health of our citizens is critically important. And when you try to overlay tax reform into that environment, you need a pretty brave political environment, because they've got so many immediate issues. Now, many of you would have seen the various versions of how we responded to this, firstly responding to the crisis we have at the moment, looking at recovery, and then hopefully going to reform. But this is not a sort of a linear process, because we're sort of, moving back and forth from just responding to recovery. But I do fundamentally agree with the response that says we must take this opportunity of major disruption to look at reform. But
you have to put it into political context. And I have had a chance to review this report that I'll speak to with the Board of Treasurers and got a sense of where they are at the moment. So, you know, enormous change. When we started this review 12 months ago, you know, the budget was in surplus. They were looking at, you know, another 10 years of generally okay budget, but they did see a gap sort of starting to, you know, to appear out 10 to 15 years out. And then we had bushfires, we had floods, and now we've got the pandemic. So our focus very much changed, and I should say Anne Toomey was on the panel with me, and Anne, you know, knows the Constitution so well, and we did look at all the issues around federal relationships. We had John Anderson, who brought a wonderful political context, and he was obviously involved in GST implementation. We had Bill English on the panel, and Bill, you know, had lived through the changes in New Zealand. Had Jane Holton, who brought the public sector view, and then, of course, John Fairbairn, who was a tax expert from Melbourne. So it was a very good panel as we started to look at this. But our focus very much, you know, moved through the period to looking at how we could support economic recovery, not just tax reform and efficient taxes, but economic recovery. But also at the back of my mind was the sustainability and also how we can have a sense of fairness in terms of the tax burden to deliver the high level of services and infrastructure that we need, and of course restoring, you know, the state's, in this case, financial capability, because as you all know, those deficits are looking very, very unhealthy as we go forward. So thankfully we had strong balance sheets going into COVID crisis, but they are going to look significantly, you know, less robust as we go forward, and so we need to set up for the future. Now, as you all know, you know, our whole income tax structure is very heavily skewed to income. And, you know, when you start to look at consumption tax, I think, you know, we may be number lowest in terms of vertical fiscal imbalance, as David talked about for, you know, that particular metric. But on GST, we're the third lowest in OECD countries. So we have a very low consumption tax. Australia GST consumption tax is about 12%. I think New Zealand is now 30% of their total tax take. But when you start to dig deeper, you've got all these imbalances that the Federation bring. You know, so the Commonwealth collects income tax, it collects the GST, but it's distributed to the states. So we have this ridiculous situation when the Treasurer, the Federal Treasurer, is after our GST reform. He says, well, the states can do whatever they like. And, of course, they can't do whatever they like. It needs to be a partnership going forward. You know, but 50% of all government expenditure is at the state level. This whole principle of subsidiarity, which Anne can talk to around, you know, the frontline delivery of services should be at the, you know, the point closest to the community. And yet all our movement in terms of funding is sort of does not align to that. But we are getting a rising demand. I just look at healthcare and, you know, the incredible demand both through COVID, but just generally with the aging population, all these pressures, you know, that are coming in that people are not recognizing. And yet our tax to GDP levels are one of the lowest in OECD countries if you take out, you know, pensions and superannuation. So we actually don't do too badly, you know, but we always talk around high corporate tax, high personal income tax, but the whole story is not often put out there. I'm involved with the BCA at the moment. They're doing a review of tax reform as well. They're very much looking at how we can, you know, look at tax reform in terms of, you know, supply side, how we can incentivize investment, you know, which is going to create jobs to go forward, rather than, you know, taxing at the other end. So we looked at a whole raft of things. We did tend to look at tax efficiencies because we thought that was really important. And because it was a New South Wales initiated reform, we looked at efficiencies of taxes at the state level. We commented, as you saw, on GST, but we did very much look at state reform. So let me just talk a little bit about that because, Ross has already mentioned it. Firstly, we had a very strong view, and this whole question around stamp duties versus land tax has been around forever. There's nothing new that we found, but we need political strength to step into these fundamentally inefficient taxes and also set a base that is aligned to wealth creation going forward. So we had a big discussion around, recommendation around stamp duty to land tax. But as you look at that, and you've seen in the ACT, how you implement it is as important as saying you're going to do it. And it's not easy. And sort of doing it overnight is not going to work. So I think David mentioned in a conversation about this takes time to implement reform, and we need to really carefully look at how we do that. We talked around payroll tax as well. And as Ross said, a lot of people talk around being a tax on labour. Here we are trying to create jobs, and we've got a tax on labour. We found it reasonably efficient, but the inconsistencies between the states, as you see in the report, is just ridiculous. So we felt that there was an opportunity for harmonisation. I've been on the other side of the negotiating table, and, you play states off against each other. Who's going to give me a better, cut here as you're trying to attract investment into the state. So we do think that the payroll taxes can be made better. We think harmonisation and simplification is important. For New South Wales, we have these ridiculous insurance taxes that people think are somehow hidden away. It's a bit like all these levies that are slowly sort of, raising their head. I know we've got a mental health levy in Victoria. We've got, the Medicare levy. And what's happening is that we're just getting more and more complication. I think we've now got over 100 taxes between state and federal, and yet I think it's less than 10, actually generate sort of 85%, 90% of taxes. So, lots of considerations that we looked at. In terms of the GST, look, we do think it's time to look at it. It's been, 20 years. It hasn't really changed in that period. As I said, we're the third lowest, consumption tax. But you've got to look at why you think consumption tax, how it plays with income tax and get the balance right. It seems to be too low. Now, it just seems to be a lost opportunity as we go forward. So we do think the rate should be looked at as well. We chose not to look at HFE, and I think better people than us have looked at HFE over the years. So we sort of steered away from that because we thought it was more important to get the balance right and the states to step up and do what they can do. And look, thankfully, I think the Treasurer of New South Wales is up for change. Now, he's got to get the New South Wales Cabinet, across the line. And it is the balance between all the taxes that is very important. So we're under no illusion that reform is difficult. Do we think that it's time to bring people together? I really agree with David. I think, it is, because reform takes time, and you've got to get a meeting of the minds. You've got to keep talking about these issues. Not putting them on the table is the worst outcome. Having them on the table, working them through is really important. But fundamental to that is actually the federal relationships between state and Commonwealth and these lines of responsibility that Anne can talk to far better than I can. So I don't have a Machiavelli quote at the end, except to say I think it's great we've got this conversation going. So thanks, Greg. Back to you.
Thank you very much, David. That's been a very comprehensive survey of all of those issues, which are quite vexing, I think we all agree. Can I just ask my panellists, we're having a fair bit of sound feedback, so could each panellist mute themselves when they're not speaking? And we'll see whether that deals with the sound feedback problem. Our final speaker is Professor Anne Twomey.
Thank you very much. So I want to talk a little bit about federalism and its relationship to tax. Federalism, despite the public reaction to it, you often get it, is actually the most economically efficient of tax systems if it is properly operated, and that's the big if. We do need to make it work properly. So the good things about federalism is that it allows both competition and cooperation, and in particular innovation and customisation of policies to meet the needs of different people in different jurisdictions. So the successes in one jurisdiction can be taken up by others. So if Victoria works out a good way of doing case management in hospitals, other states will take that up. Whereas the disasters in a particular state, think WA Inc., for example, can be learnt from and avoided by the other states. So the effect of all that is to ratchet up performance through innovation and the widespread adoption of the successes while avoiding the failures. Now, apart from that ratcheting effect, federalism also gives greater choice and the ability to customise tax and policy settings according to the wishes of the people. So people in one state might prefer having low taxes with the trade-off of having fewer or lower quality services, while people of another state might actually prefer to have better services and be prepared to pay higher taxes for those services. The key thing in a federation, however, is being able to work out when competition is valuable and when it's destructive, meaning that the cooperation and uniformity is actually needed rather than competition in some fields. And this is particularly notable in the field of tax, where there are both economic and constitutional problems. So the first issue is efficiency. It's a drag on the economy for businesses that operate nationwide to have to deal with 6 intricate corporate tax systems, for example, each with their own deductions and rebates, etc. Now, for that reason, in most federations, you have some kind of a piggyback system where you have a federal tax and a state might piggyback on the top of it with a small proportion of that tax being allocated to the state. Or the alternative is to have some kind of tax sharing of the revenue with the federal system applying the tax uniformly and then sharing out the revenue amongst the various states. So if you have a look at our report on the Federal Financial Relations Review, we did have a bit of a look at that in terms of personal income tax sharing and using that as a means of getting rid of some of these quite destructive grants, tied grants that are for short term, take a lot of time and cost to negotiate and would be better off with longer term funding going to the states. So we looked at that in terms of at least an experiment, a trial thing to see whether it would work. Second problem with taxes in federation is the race to the bottom problem. So it's often the case that where you do have tax competition in a federation, each state will go around making concessions and lowering taxes in order to attract business to that state. Now that ultimately is destructive of the tax bases of the states. We've seen that happen before. It results in increased vertical fiscal imbalance, which again undermines the federal system and the efficiency of it. And it also causes greater administrative burdens to businesses as well, because you end up with widely varying conditions on taxes across the country. And when we looked at it, the name of the tax, I'm thinking payroll tax. Payroll tax was a really good example of that, where you end up with it being levied on a whole lot of different bases. You've got different conditions placed on it, different rates, different points at which it cuts in, et cetera, It makes it really messy, and that's an administrative burden on businesses as well. So the panel discussed how to instead employ cooperation in order to make payroll tax more efficient to administer, and also to prevent this race to the bottom business so that it actually is a productive tax in the tax system. Now, to add to all those economic problems, you have constitutional constraints. So there are a number of things that the Commonwealth and the state can't do in the tax field, and that affects the way you have to build your tax system. So states, as we know, can't impose excises, not even when they're disguised as a business franchise fee, as they were for many years. A state could not, for example, impose a GST. So as much as the Commonwealth likes to refer to the GST as a state tax, and even used to and probably still does account for it as that, it can't be because of the Constitution. Secondly, under the Constitution, Section 51(2) prevents the Commonwealth from taxing in a way that discriminates between states or parts of states. So this limits the Commonwealth's ability to accommodate difference in imposing its taxes. It's therefore difficult for it to send tailored pricing signals, as taxes have to be operating in the same way across all states, even when the circumstances are different. So the example here is the example of taxes on vehicles. So again, something else that we looked at. At the moment, you've got a ridiculous system where you've got the Commonwealth imposing tax on petrol, which of course doesn't apply to electric vehicles. That's supposed to be being used to repair the roads, but of course electric vehicles use the roads as well as the petrol vehicles, so it's unfair in the way it operates, and the link between the tax itself and what it's supposed to be being used for has broken down as well. John Fairbairn, if you ever listen to him talk about this, I think is really beautifully clear about it, but with that sort of a thing, we'd be much better off getting rid of the Commonwealth's tax on petrol, getting rid of the various state taxes like registration on vehicles, stamp duty on vehicles, and instead, excuse me, using tax to as a pricing signal on the various factors that are actually relevant in terms of what you're trying to achieve. So if you had a tax that looked at distance travelled by vehicle, regardless of whether it's electric or petrol, because you need to use the same amount of money to repair the roads to the damage, pollution, which is another factor which needs to be costed in, and there you would treat electric vehicles much better than petrol vehicles, so you wouldn't be doing this in a way to discriminate against electric vehicles. Actually, they would get an advantage there. And then finally, congestion, because congestion is a real burden on productivity. And so you need to be able to send those price signals to try and resolve the congestion costs and their impact upon productivity. So if we were instead more focused on what we're trying to achieve by tax, which is not just revenue, but what the revenue needs to be used for, and also using that as a pricing signal to change behaviour, we would have a much better tax system. So I'll leave that there. Thank you. I think you're still muted there, Greg.
Yeah.
I've just done what I was going to ask you all to do, and there it is. This is what happens when you're 175 years old, even older than the Federation. You make those mistakes. So what I was trying to say was that your constitutional survey there is a great segue for some of the questions that are coming in. I think if I could just venture a thought in advance of that, tax reform is an act of imagination, in my view, first and foremost. You basically need to imagine a better world, and then if you can share that vision, you may get support for moving towards it. And the Federation, when we built it, was an act of imagination based probably on the United States model of each state doing its own thing. It was probably more of a competitive model. The more modern federations, like the modern German Federation and perhaps some others, perhaps built on a different foundation, a different imagined world. And one of the features of that is that in Germany, there's more tax sharing, I think, than there is in the Australian and American models. Certainly the American, but the Australian version. And a lot of people would like to see, the Henry Review, for example, said let's just have 4 big tax bases. But that kind of drives you towards the German model, which is let's have just big federal taxes and maybe move towards sharing those revenues on some more coherent basis than we currently do. So I'm just interested in asking the panel, particularly those who, the two of you have been involved in the review process very recently, but also the one back in 2014. Do you think that Australia's future tax system would be at best be based on that German style of model of collect efficient central taxes on broad bases and perhaps downplay the state taxes? Or do you think that we are obliged in the way of the world, and in particular on the theory of federation, to continue with the states collecting a lot of their own taxes? So I might start with David Thodey on that, if that's okay.
Yeah, by all means, Greg. Well, I really like your introduction, which was, you've got to imagine the world that you want to go to. I mean, in business, you design financial systems around what your strategy is, not let the financials get in the way of where you want to go. So I'm not sure I would choose between the German or the US, but I would say, what sort of Australia do we want to create over the next 50 years? And I do agree, and Anne may correct me here, but federation needs to evolve. It needs to be fit for purpose about the world we want to create. And I think the world is changing. I mean, you look at the impact of information flow, people flow, the dynamics of where expenditure is. Look at the GST. We've seen a decline in the GST take because of fundamentally a lot of goods and services being bought online that weren't subject to GST to a degree, household expenditure changing. So I would go back to not choosing between German or the US, but saying we're a country of 25 million. Let's say we grow to 40 million by, the middle of this century, whatever it is. What type of country do we want to be? How do we want to set up the relationship between states and Commonwealth? I do personally agree with the principle of those who are performing the task, i.e. state or local, should have better control of the revenues and expenditure. But you've got to have accountability there too. And so often we've not had the accountability clearly enough defined. So I'm sorry, I probably haven't completely answered your question. But I do think that the reason that we need to reimagine what country, what nation we want to have for the future, then let the tax and the revenues and expenditure flow from that. Because I think if you go the other way, you end up just complicating things. So if you go to 5 taxes, well, if that means that the people who are delivering have no control over the expenditure and revenue, that's not a good outcome, I don't think, personally. Then we argue around who gets what share, and Western Australia says, oh, well, I need more because my economy's stronger, and we don't. And the whole fundamentals of federation about, the equalisation goes away. So that'd be my view. I don't know, Anne? Sorry, Greg, you're in charge.
That's fine. I'm happy to go to Anne, but I'm going to give everyone a go on this one.
Well, I actually completely agree with David on all of that. I think it does need to be a bit of both. And again, that's why I think that federalism is a great system, because it does allow for both. It's not one thing or another. It does allow flexibility. And so federalism is all about calibrating things, right? Trying to work out which bit works better where. And we're not good enough at the calibration. That's where we fall down, that it has to be in one camp or another. But it's just a matter of adjusting things to making it work properly. So I agree completely with David that states and local government need to take responsibility in relation to their funding. So if a state was just simply getting revenue without having any control over it or indeed any responsibility for raising it and could just blame the feds all the time in relation to everything, well, that really takes away your accountability. So states really do need to have their own tax base. But equally, as I said, there are many circumstances in which it's just inefficient for the state to be doing the taxing. And in those circumstances, maybe you do need some tax sharing. So it needs to be a bit of both. You've got to make sure that the states still have responsibility and a degree of control over what they do so that they are accountable for what they do. But at the same time, you don't want to say that everything has to be done, locally at a state level, because that leads to a whole lot of inefficiency in terms of how you tax. So a bit of both is what I'd say.
Thanks, Anne. David Di Cavallo, I think your review also looked at these questions, and I'm just going to, because you're from ACARA, I just want to insert this thought that about 2/3 of state spending is in fact in the health, education, welfare sector, in other words, social spending. And that 2/3 is actually only a minority of the Australian government spending in those areas. And in all of those areas, the Australian government actually dominates. But the states, it's 2/3 of the states. So does that, does that change the way we feel about the federation and the sharing of taxes?
Yes, thanks, Greg. And I'd like to go back to a point that Anne was making around the degree of accountability that states have for their and their ability, linked to that accountability, their ability to raise revenue that is more commensurate with their spending responsibilities. And this is the problem that we've got in the way that the vertical fiscal imbalance works in Australia, where most of the money that the state governments spend in those big areas of health, education, etc., a lot of it comes to them from the Commonwealth, and the Commonwealth therefore feels entitled to put a range of constraints on how that money is spent in terms of Section 96 grants, etc. And so this is the problem that Mr. Abbott was trying to address, that the Commonwealth, going back to 1902 and Alfred Deakin's sort of reference to the power of the purse, whereby it would hitch the states to the chariot wheels of the Commonwealth. That is a problem in terms of political accountability in this country. And the attempt in 2016, through the tax and federation reform process, to at least canvass the issue of income tax sharing such that states would get a share of federal income tax and have over time an ability to dial that up or down according to its own lights in terms of where it would like to go in terms of levels of service delivery. That conversation, had it been handled more deftly at the time, could have led to a very interesting discussion and a long-term agenda around the realignment of revenue bases with expenditure responsibilities. And I think if there is anything that we could be doing in terms of structural reform of the tax system, that is an area that we need to look at more closely.
Ross.
Thank you, Greg. Look, I think the point about it being outcomes focused is really important, and I like what David was where he thought he was going with respect to saying an Australian way. What do we need for Australia? We don't have to be tied to sort of the legacies of the past, but I think in terms of that outcome focus, it really is on efficiency and fairness. What we currently have the opportunity for, and Anne mentioned this earlier, is this competitive element that can come in and be debated and benefit from improvements in terms of the tax system, so that we can sort of achieve more successfully those outcomes we're after. And I think we're seeing that, some of the problems that are currently being highlighted in terms of the vertical fiscal imbalances and the tensions between, the sharing of revenue, sharing of expenditures and sharing of functions. There's got to be a way where we can sort of go, we know we've got these inherent problems, but we also know we've got a system that's capable of so much more. So how do we pull it together so that we can reduce those administrative burdens that are currently in the system, but also try to really get it to the point where we aren't getting those distortionary effects that are impeding activity. So I'm not sure I've got much more to contribute there, but I think there's a richness here. There's an opportunity here.
Okay, thanks very much, Ross, and thanks to everyone on the panel on that topic, which I think got us right to one of the core issues. There is perhaps narrowing it down now. If we are in fact still going to stick with a state role, one of the big taxes, I think the biggest revenue earner for the states is in fact the payroll tax. And there is an interesting, we've had questions on the relationship perhaps between the payroll tax and the GST. I know there's a lot of uncertainty as to what the true incidence or the economic incidence of the payroll tax actually is. But the question really goes to, what should we see the payroll tax as other countries perhaps do, although theirs is a social security-based tax, should we see that as an efficient adjunct to the GST, or has the time come to make a radical reform to the GST, to the payroll tax, and does it have a place in the future tax system? So I'm not quite sure who's best qualified to speak on that, but I thought I'd start with David Thodey again, if that's all right, David.
Yeah, we didn't conclude that, Greg. We thought that despite the appearance of a tax on labour, we didn't conclude to take it away. We just thought it needed to be harmonised and more standardised. We do think that GST, a consumption tax, is important, but well, the data we've seen, and unless there's different data around, it looked like a reasonably efficient tax to collect. It's just how it's implemented and the relationship between the states. But we do think that when you look at this, the overall structure of the tax. By the way, I think transfer duty is still the larger tax in the state. I don't think payroll tax is the largest. I may be wrong, but I think it is.
It depends on the property cycle, I think.
yeah, I think you may be right. So we think it probably still has a role for the states. I mean, personally, we'd probably like to see it phased out over the longer term, but we just don't know if you could transition that quickly. But I don't know. Ross and David may have a better view. I don't know about Anne, but that was where we got to on it.
Ross, I thought you might have a view, Ross.
Yeah, thanks, Greg. Look, I think the point about, we'd definitely like to see the phasing out of payroll tax. There's no doubt about that. And I know that there's sort of been this uncertainty in terms of the incidence. And there's also been quite an ongoing disagreement between the equivalence of a payroll tax and a consumption tax. I think when we look at that in particular, and you look at the argument that was really presented in the tax review, the Henry Review, at the back, when you look at the key assumptions to demonstrate that equivalence, I think you can sort of safely say if you relax them and get closer to a real world, then there is a difference. Just broadly, a payroll tax will have a far narrower base and will do greater damage to local employment than a consumption tax. So I think there is a difference. I think there are gains to be had from its removal, but I do take David's point. This is about phasing it out. And I think on that journey to phasing it out, the best thing we can do is try to find how we can reduce the administrative cost of them. And the impact on businesses, which, harmonisation would be a great first move, but also what can we do in terms of how businesses pay this tax to sort of reduce the costs that they're currently incurring. So, yep, it's got to go, but let's be realistic. It's not for tomorrow, but we can make some changes in the meantime.
Thanks, Ross. Does anyone else want to comment on the payroll tax?
I'll just be very brief, Greg, not so much about payroll tax specifically, but about the issue of harmonisation of state taxes. And I know David avoided in his New South Wales exercise going near horizontal fiscal equalisation, but HFE is an important part of our system in terms of interjurisdictional equity for all citizens. The problem that we've got is the way that it currently works. I do think it was a mistake to add in a federal top-up recently to the GST pool to account for a temporary situation in Western Australia that has clouded the GST distribution formula considerably. But the other issue is harmonisation would address one of these issues whereby the Commonwealth has to look at the different effort that states make in terms of levying their state tax bases. If you have a harmonised state tax regime like that, it takes a lot of the controversy out of the way the HFE formula it works.
Well, that perhaps gets me to the next question, which to some extent might be the last question, which is that if we look at if we look at the commentary that we had in the first session today, there's a lot of demands in our community for services, and most of these services in health, education, welfare, perhaps also in justice and transport, but health, education and welfare are the expensive ones, are pretty much dominating the task of the tax system. So the tax system task seems to really flow as an adjunct to these other demands. And I'm interested to know, and the question is also asked whether panellists have views on that. And it goes also to the Federation again, because if you take the view that those things, health, education and welfare, are seen as a sort of a national level of commitment, whether it's because we have a national labour market or whether it's because we have national sense of, what's fair and just. If they are a national level of commitment, what does that really mean for the Federation? I think Anne did say some things about the fact that we've got these choices, but is it the reality that most of these choices are driving us towards fiscal equalisation, horizontal fiscal equalisation, with essentially a dominant role of the Commonwealth in funding? And if that's the case, will that system persist? Because we're now seeing more and more inequality between the jurisdictions than ever before. I think that would be a fair statement to say that Australia's Federation is starting to come under the strain of quite radically different fiscal capacities across the states. So I'm interested in whether or not there are some views of the panel on that, and I thought I'd start with Anne on that one.
Yes, so one of the things that we did discuss quite a deal on the panel was the problem that if you do make really hard reforms and engage in innovation, you can end up being penalised for doing so through, for example, your GST. And so there's a bit of discussion in the report about proposed if a state go and, take the political pain system more efficient, it shouldn't then lose out in the GST distribution by simply losing the equivalent of what it had achieved by becoming more efficient. So there are a lot of perverse incentives in the HFE system, The reason we didn't want to get into HFE in any big way was simply because we wanted to try and get reform that would bring all states on board. This wasn't supposed to be an exercise in New South Wales ganging up on any other state. If we're going to have any kind of chance of reform, we need to do it in a cooperative manner. But the one thing that we do need to take into account is that if a state does take those efforts to improve its economy and its productivity, the consequence of that will be the Commonwealth, for example, receiving greater tax revenue because you've increased your employment, you've got people earning more wages, they're paying more income tax, etc., etc. And by doing that, in the end, you lift everybody up. So we need to focus on ways of lifting everybody up by increasing the pool of tax, and that includes making the kind of innovations and changes that make your economy more productive and not being penalised for doing so. So that's quite a serious issue that we can address.
Thanks, Anne. Look, I've just got, I think we've just got 2 or 3 minutes left, so I might just invite the other speakers. David Di Cabapo, do you want to say anything perhaps in sort of the 60-second grab?
Yeah, thanks, Greg. Look, I think the point that Anne was just making there about the horizontal fiscal equalisation is very important. I'm a strong believer that we do need to maintain that system in terms of equity across the country, but we do need to look at how the system works to make sure that it doesn't disincentivise the kind of innovation that she was talking about. More broadly, though, I think we do need to come back to this issue of how do we ensure that states have a greater ability to fund their own levels of service delivery. I think that's a core question for us. It does go to the issue of the fact that the GST is constitutionally difficult. It's not a state tax and yet it's distributed to them. Politically, this means that it's very difficult to make any changes to the level of the GST because the Commonwealth says, as David Thodey pointed out, we'll lift the rate of the GST if the states agree. And of course, the states would prefer to have the benefit of spending the GST without the political pain of raising it. And we have to realign those political incentives.
Thanks, David. Ross, did you have something to finish with?
Yeah, look, I think this all really boils down to the real issue here, and that is the problem we're truly facing here is a national one. And that is, as a nation, how do we best meet the growing demand for government services? And that's the key issue here. And I think, we can look at it from a purely economic perspective and say, look, it makes no sense to consider state and federal taxes separately. People, businesses and households don't care who they're paying their taxes to. But we know, given this constitutional federation, and particularly with the vertical fiscal imbalance issues that we've got, that it does matter. So this is really political economy. And I think, we've just got to remind ourselves, the whole system's evolving, the context is evolving. And look, progress on this is glacial. And I think that's a big concern. But it does afford us time to really consider some of these issues broadly, but not lose sight of the fundamental problem. And we've got to keep that in front of our minds.
And finally, David.
Thanks, Greg. Well, I definitely think we need to lift our standards nationally across all those areas. And I think it is timely to look at the clarity of responsibilities between states and the Commonwealth to get the best outcomes for citizens and not be bound by what has been there before. And I think, quite honestly, there is an appetite to look at that again. And within the Constitution, but maybe some of these boundaries have become too opaque and it's lacking accountability for real outcomes. So I'm a strong advocate for a relook at it, which I think David mentioned earlier on too, and Ross.
Okay, well, thanks very much to my panel. And I think we're just on time now to hand across to Bob Brunig, who will finalise the session in the remaining 15 minutes today. Thank you, everyone. Okay, so I am taking back over briefly because I'm not quite sure why. I think we haven't been able to get hold of Bob. So we're just trying to get Bob back on. So basically, I'm not sure that there's a lot that I can do. No, Bob's back on. So thanks, Bob. Take it away. Bob is either muted or is not there. He's trying to unmute. Bob is trying to unmute, and we're hopeful that he'll be in a position very soon to join us. He's got Kirsten, so... Excuse me, everyone, I'm just talking away. I have no idea whether I'm even going out. The inevitability of a slight delay and difficulty with okay. Bob is having trouble getting unmuted, is what's happening. Okay, so it doesn't look like we're going to get Bob back on, which means that although I'm rapidly reading the discourse that's going on trying to get Bob back on, I'm facing the possibility of having to thank everybody for today's event, which I think has been an exceptionally good event. Those of us who were consulted sometimes thought that perhaps this was premature. Others thought that this was very much the right time to get into this issue. And I think that today what we've at least seen is that all of these issues have been given a good run and that they're still relevant and very much ones that people want to get on with. So as I'm speaking, I'm looking again to see whether or not we're going to get Bob back on. He was on briefly and then disappeared. So he's going to reconnect, I believe. And so once he's reconnected, this takes usually about 1 minute. So hopefully once Bob's done that, because ironically enough, he's able to communicate with us while this is going on. It's just that we've been unable to get the sound through from him. But I'm pretty keen to get him.
Right.
And I can hear other voices.
Can you hear me now?
Bob, I can hear you.
That sounds good. Can we see me? Am I on the...
I can't see you, but yes, now I can. I'm handing over to you, Bob, because I can see and hear you.
Thanks, Greg. I hope we didn't lose too many people in that little bit of craziness, but it's all for a good cause. So I'm gonna start by saying that am I visible to people? Yeah. Okay, so I'm just going to start by thanking all of the speakers. I thought it was a fantastic day. I really enjoyed the diversity of things that people had to say. I hope other people enjoyed this as much as I did. I really enjoyed it tremendously. I wanted to, I guess I'll just do 5 to 10 minutes of wrap up or a couple of comments. I guess I want to go back to a comment that Sonia made early in the day when she sort of said that young people are in many ways not that interested in paying attention to taxes, but they do believe that Australia is going to look after them. They do believe that Australia is going to leave them with a tax system and a budget situation that's not going to ruin their future lives. And we're the people who've seen the light in the room. And so I think it's up to us to make sure that happens. I mean, we are at risk of leaving future generations with both enormous debt burdens and a tax system that is completely unable to pay for that. And I think the two, so at the beginning of the day, Tom talked about the fact that you need to have consensus about the problem and you need to have consensus about the goal. What is the thing that you're trying to fix? What is the thing you're trying to change? I think Australia is a compassionate country. I think it's something that people in Australia value. We value taking care of those who are less fortunate. We value taking care of the aged. We want to make sure young people get a fair go and they can get jobs and get support. And I think that one of the themes that's really come out of this today is that our tax system actually is not up to the task of funding this. Ken Henry said that they had identified this back 10 years ago and even before, that we were dependent on these tax bases to fund our future expenditure, which we know is going to go up with an aging population. And we just have these tax bases that are really not up to the job. And so adequacy, I think, has come out as a really strong theme of one of the problems. Our system is inadequate. It's not up to the task that we've set it to be the kind of country that we want to be. I think a second thing that's really come out as another fundamental theme and a theme that could potentially resonate with Australians is around the theme of fairness. And our tax system isn't fair. And there are some people who are very wealthy who pay very little tax. Taxpayers who have similar amounts of income are not necessarily paying the same amount of tax. And we need to do something about that. Tom also talked about this morning about the importance of economists and tax people being able to communicate to the public about the nature of problems, and the idea of kind of economic literacy and taxpayer literacy came up a couple of times today. And when I think about that literacy problem in relation to those two goals, I think we have a major problem. I think when you go out into the street and you say to people, do we have a structural problem with our tax system being unable to afford the things that we want to pay for in Australia? I think the average person would say no. They're not aware that that's a problem. And yet all of us gathered here today understand that that's a problem. So I think one of the things we need to take out of this is we all need to speak with our many multiple voices that are not going to be identical, but about the problem and about educating people about this problem of affordability. I think the second problem around economic literacy is economic literacy around the problem of fairness. I think the nature of the unfairness problem is not well understood. And this came up today at several different places. So often we sort of see calls for, rich people should pay more tax and therefore we should have higher personal income tax rates, for example, just as one example. But the problem is there's lots of people who don't pay any income tax. And so you could make the tax rate 100% and it's still not going to affect them. And so the unfairness problem is not just about rates, but it's also about the base of tax. It's also about the things that we tax and whether we're taxing the right things. There was talk about inequality. I think the evidence in Australia is that there hasn't been a lot of growth in income inequality over the last 20 years, but there's been perhaps growth in wealth inequality. That suggests that the problem is going to lie in somehow getting at the taxation of savings or the taxation of wealth rather necessarily than the taxation of income. I thought all of the conversations today were really, really important. What did I guess, think that we were going to come out of today? I guess I thought we were going to come out with a sharper idea of the problem. I think we have that. We have a sharper idea that there's a problem of adequacy. We have a sharper idea that there's a problem of fairness. I thought we came out of today with an incredible amount of agreement. I heard people across the board making reference to the same kind of problems and the same kind of issues. People don't necessarily agree on how to solve these issues, but I think there's widespread agreement on the problem, and that's the first thing that we need to do. I think the other thing we came out of today with is an even stronger sense of community amongst those of us who think about tax and care about tax. The Tax and Transfer Policy Institute is really keen to keep this conversation going, really keen to have a lot of voices that come together around this debate and talk about that, and really keen to also use that to increase economic literacy and knowledge about the population. So I think I might just leave it at there. I thought it was a fantastic day. I'm hoping that we can have more summits like this, more meetings like this. And for those of you who I had not met before in person, it was good to meet you virtually. It's great to be part of a community of people that I think are really working for the well-being of Australia and to make this country the best it can be. So I'm going to give a final thank you to all of you who were participating as discussants, participating as panel chairs. Big thanks to Tom Barthold for joining us from the U.S. and sticking with us. And a big thanks to all of you who are participating. And with that, I'm going to draw this National Tax Summit to a close. Thank you.